we also have an opportunity to do a digital channel. We already see right now that our customers are start buying the phones and upgrades digitally, and that's a new normal. So that means that we also have means to actually handle this. So I'm as confident as I can be at this moment, of course, with uncertainty of a second half. But right now we're executing on the plan as it would be a almost normal second half when it comes to handset technology and uses of our network.
Right. Well, that's a hope there. Finally, Hans, you've mentioned the new normal a number of times. So what are you doing to sort of prepare for the environment that we're going to all inhabit once we get, so to speak, on the other side of this virus? I mean, what's going to be different that's going to stay different for Verizon and its customers and its employees?
I think we're going to see a lot of new products that are geared for working from home, telemedicine, education from home. In a time that would be impossible, will now be broken down. The way we're working in our office, etc. So that will continue in the new normal. So, and we are catering for new products, but
Okay, people, I've got the daily checklist. Who today has eaten dinner for breakfast? Tick. Started a chore you'll never finish? Tick. Done a conference call in your pajamas? Tick. Here's another for your list. BritBox. Streaming the BBC, ITV, Channel 5, and now Channel 4. All in one place and ad-free. So add BritBox to your list and get a 30-day free trial of the biggest box of British box sets. Search BritBox free trial. Tick. Biggest compared to other SVOD providers. Auto-renews at $5.99 a month unless cancelled. T's and C's apply.
A good basis for going forward when you come out from this, but clearly a downturn now.
Yeah. Hans, always appreciate your taking time and very much happy that you've been able to share your insights with us over these last very difficult weeks. Look forward to seeing you again soon. Hans Vestberg, Chairman and CEO of Verizon. Carl?
All right, David, our thanks to Jim. Hope he has a good weekend. We'll see him tonight on Mad Money. S&P has gone red.
Impromptu boozy party? What do you guys say? Zoom? 2 o'clock tomorrow.
We'll wait for the invite,
sure,
Jim.
2 o'clock tomorrow. I'm going to do one. Just drop by.
Have a good weekend, Jim. We'll see you at 6 p.m. Good Friday morning, everybody. Welcome to Squawk on the Street. I'm Carl Quintanilla with David Faber, Sarah Eisen, live from various locations. Trying to hang on to the green here. Dow session high was up 202. The data's been weak. Durables, UK retail sales, and now UMich. Let's get to Rick Santelli.
Yes, our final read for April on University of Michigan sentiment. And do remember, our mid-month read was 71. So it moved from 71 to the new final at 71.8. That is the lowest final read since the end of 2011, December 2011. And maybe one of the reasons the market's moving, of course, maybe some thought they'd see a little bit more of a bounce off the mid-month read. Since this is April, it definitely is catching corona economic effects. And if we dig through it a bit, the current conditions move from 72.4 mid-month to 74.3. And our final read on the inflation numbers, 1-year inflation at 2.1, same as mid-month, and 2.5 on 5 to 10 year. Now, we know that 1-year inflation rate has come down, and I'm sure that at least in part, that's coronavirus related. There's many deflationary pressures going through the economy. Carl, back to you.
All right, Rick, thank you very much. We'll keep our eye on all of that data as we, Sarah, take a look at Georgia and try to gauge consumer reaction to their loosening of restrictions. The president is going to sign that aid measure that was passed by the House yesterday. $484 billion is now Mnuchin and others talk about what comes next.
And we find ourselves in this sort of new trading range after the market has rebounded so strongly from those March lows after that deep sell-off. We've sort of been going back and forth, and you can see it in the flat action today. Also was on board for that Gilead roller coaster ride yesterday. And one point, just in speaking to traders and people about how much the market is pinning their hopes on this Gilead remdesivir and that sort of disappointing word we got, according to the FT, according to the WHO from China, that it was a flop, which Gilead says, sort of there's still hope for this drug. There's so many other treatments out there that I just wanted to bring some attention to that maybe don't get as much attention as the Gilead remdesivir. You've got Roche's anti-inflammatory drug being tested, Regeneron's cocktail of antibodies being tested. You've got the convalescent plasma study going on across hospitals in this country led by the Mayo Clinic. You've got other anti-inflammatory drugs and some smaller drugs as well from Distributed Bio and other from countries in Japan and Israel. So that continues to fuel some hope, I think, out there that we can perhaps open normally if we get some sort of good treatment against this disease. In the meantime, you've got stimulus flowing. And there is some breaking news on that from the Federal Reserve, adjusting some rules around bank accounts and making some other headlines. Steve Leisman with the details. Steve.
Yeah, Sarah, from the medicine needed to attack the virus to the medicine that's being used to help the economy, the Federal Reserve releasing some data about the lending programs that it has launched, the emergency lending programs that it's launched for the virus. And this is part of a required disclosure under the Dodd-Frank rules when the Fed uses emergency lending power. So the Fed is saying that under the primary dealer credit facility, it has loaned $34.5 billion. This is through the middle of April. And that's a facility for primary dealers to get loans up to 90 days. Under the commercial paper facility, it has loaned about $250 million. And under the money market facility, $51 billion. The Federal Reserve saying it doesn't really anticipate losses from this. That's part of the reporting requirement. And under one of the programs, it's actually earned so far $5 million of interest. Which one was that? That was the PDCF. It's earned $5 million of interest. So, Sarah, this is part of the new disclosure when the Fed uses its emergency powers. It's got to report to Congress. The Fed yesterday told us that under the CARE Act programs that it's administering, we're going to get disclosures of the names, the amount of loans every 30 days. Sarah?
Steve Leisman. Steve, thank you. Also seeing a headline that the Fed now can allow customers to make unlimited transfers and withdrawals from their savings account, removing the 6-month rule. Carl.
All right, Sarah, we'll keep our eye on that. Obviously, a lot going on. Even as we're talking about those prospective treatments, Sarah, the FDA now out with a statement warning against the use of hydroxychloroquine and erythromycin. So we'll watch that as well, along with the markets. Joining us today, Harris Associates' David Harrow is joining us. He manages several Oakmark funds. David, happy Friday to you. Good to talk to you.
Good morning. Happy Friday to you as well from chilly, cloudy Wisconsin.
Yes, same weather here. I wonder if you could talk about just the range we're in. And, there's been so much discussion of 2,800, 2,820. We obviously got denied yesterday. It's hard to know if that's because valuations are at a 2-decade high or because we got some random headline that was net negative on Gilead. Why do you think that number seems to be increasingly important?
Yeah, well, I, as a long-term kind of value investor, don't really focus on these day-to-day price movements and technical levels, but I will say this. The U.S. markets had a relatively stronger recovery than, say, what's been happening overseas, Europe in particular. And I think there are areas that are still extremely oversold, and this is where the investor focus should be on. Places where there's good global businesses, good global franchises, but share price is still down 30, 40, 50% year to date. So these day-to-day changes in the U.S., they make for good kind of play-by-play, but we really try to focus on, buying the best quality businesses at the lowest prices, and where the market has let fear overrun any sense of basic valuation parameters. And so to that degree, I think these markets still offer lots of value if you look at the right places.
All right, and those right places involve sectors like?
Like if you look at the European financials as an example, they're down anywhere from 35 to 50% year to date. Yesterday, a company like Credit Suisse reported earnings. This is a company that is very well diversified from both products and from geography. It has a good, solid, sound balance sheet. There's other European financials like a BNP Paribas. These things are trading at 35% of price to tangible book value. And they are very, very strongly protected given the strength on their balance sheet. And they've just kind of been ignored and almost used as shorting tools by investors, by traders. But real investors have an opportunity here. For when they recover, when these types of businesses recover, they're not going to be up 20 or 30%. They're going to be up, 50, 100, 120% when the recovery does come. And I think these are the types of situations investors should be looking at. They should be looking forward as opposed to just looking in the rearview mirror.
David, I know you've been beating that drum on the European banks for a while now, but it's interesting to me that you picked up a few names in some more hated spaces like Energy Exploration and Production Company, EOG, and Booking Holding in the hospitality sector. Why are you going for some of those riskier type names in this, economic shutdown?
Well, in the travel space in particular, what we like are those businesses that are asset light and strong balance sheets. And a company like Booking, for instance, is very asset light, and it has the financial strength and balance sheet to make it through this. Eventually, travel returns. Of course, we don't know at what type of level or speed this return occurs, but travel will return. And so we look for companies like a Booking. In our international portfolios, we own Trip, which is the biggest online travel agency in China. So there are ways that you could play a return to travel in a more asset-light, lower-risk manner. And a company like Booking or a company like Trip are two examples of this.
What about Energy?
Yeah, in our international portfolios, we're really just exposed to one Canadian producer, Cenovus. And we do believe that today's price of energy is actually quite unrealistic. 6, 9, 12, 18 months from now, it's unlikely that these low prices will be maintained. Now, over the medium and long term, it's hard to be an oil bull given the supply conditions and the demand conditions. But in the short and medium term, we think there are places where you could advantage yourself by looking at select energy companies that have good low-cost exposure to gas, and good exposure to the market, meaning getting their product to the market. But you have to be very selective.
David, when you're talking...
And you have to be very balanced.
I was going to say...
Very balanced.
When you're talking about these opportunities, are you talking about equities specifically or credit? Or, to what degree do stock pickers need to be worried about dilution down the road? Is the behavior in high yield going to lead equities eventually? Because people are really now having to parse the various qualities of the capital structure.
Yeah, you really have to look at this period of economic instability. Balance sheet has to be almost the first and foremost. Balance sheet and cash flow generation during the next 3, 4, 5 months has to be the key focus of any investor, because first and foremost, a company has to make it through the period. Then you have to look at the business model. And as the recovery begins to take shape, and there will be some recovery, and as who will be the winners? Who is positioned to take advantage of a recovering global economy? So these are the things we really try to measure and take a look at when valuing businesses. And, the market has even gotten shorter term than normal. If the market used to be focused on, the next couple of quarters, today the market seems to be focused, the stock market that is, on the next couple days or the next couple weeks. And if you're a real long-term value-oriented investor, you can take advantage of this. Right now, we're certainly out of favor, but it will bounce back and it will come back, and people will begin to consider valuation and price. And this is something they're not considering today. But to get to that stage, you need to make sure you're invested in businesses that are soundly financed and have a business model that will allow success for when the recovery begins.
Yeah, David, it's easy to blame the market for being short-sighted, but they've got huge swaths of just a vacuum of corporate guidance where companies aren't giving us any clue. Huge binary outcomes on things that are coming in the next couple of days, like how consumers in Georgia respond to these relaxations. I mean, it's hard to get around that, isn't it?
Yeah, we do have some clues, though, because you could look at, of course, China isn't the place where you get the most accurate data from. But, China was kind of first in this and first out. And we can kind of look over at China and see how consumer behavior is happening. And in fact, in the auto sector, we see, a February in China was down 75%, but then we saw a March that was down 40 to 45%. And in April, we could see this data is, far more constructive with sales, maybe some of our premium producers only down 0 to 10%. So we could see as we come out in China, we could see some better consumer behavior. A lot of the sell-side firms have measurements of restaurant occupancy, and people are returning to restaurants and buying cars in China. So every place is going to be a little different, of course. Consumer behavior is not so monolithic. But, we do know that as time passes and we get through the health portion of this crisis, this will also begin to ease up the economic portion of the crisis. But, it's going to take some time. But as investors, we know that our business valuations aren't just the next couple quarters. It's the next year, the year after, and all the way to perpetuity. And so we have to consider everything and not just the couple of weeks or quarters where it's very difficult. One of the reasons why you're not getting the guidance we all want is because no one really knows what's going to happen in the very short term.
That's where value investors definitely play a role, David. It's good insight on this Friday. I hope the weather improves over the weekend. We'll see you soon.
Thank you very much for having me. Take care.
All right, sending it out back to David Faber, who's got some news. David.
Yeah, I got some breaking news. AT&T is having its annual meeting virtually, and I did want to share news that we did just get from Randall Stephenson, of course, the company's chairman and CEO. He will be stepping down as the CEO of AT&T on July 1st to be taken over in that role by John Stankey, of course, the man who is currently number 2 at AT&T, overseeing Warner Media. But John Stankey will become the CEO of AT&T on the 1st of July. Stephenson saying he's retiring after serving, of course, his 13 years as the company's chairman and CEO. He will remain as the executive chairman of the board of directors until January of next year, 2021. And again, the company's president and chief operating officer, John Stankey, will become the CEO effective July 1st and also a member of the board of directors. Now, not unexpected in many ways. Stevenson was expected to step down during the course of this year. Obviously, nobody knew that we would be in the midst of the crisis that we are right now. One question had been whether Stankey would be deemed to be the gentleman or lady to take over for him, but of course the board has decided to move in that direction. Don't forget, Elliott management, despite percentage-wise quite small overall percentage ownership, has had an influential role at the company to some extent. And I do have a statement from their partner, Jesse Cohn, saying that they support John Stankey as the company's next CEO. They say they've been engaged with the company throughout the search process, that it was a robust one. Again, this is Elliott speaking here, including a range of highly qualified outside candidates overseen by independent directors, and they look forward to working with Mr. Stankey as he begins his term as CEO. Stevenson, of course, changing AT&T dramatically over the course of the 13 years that he has overseen the company with significant acquisitions, the likes of which we know well, DirecTV, which has certainly not been the best of deals given the decline in subscribers there. And, of course, topped by the acquisition of Time Warner, which took quite some time to get done given the opposition of the federal government to it, the trial that they had to go through to actually get that deal done, which cost them valuable time. But moving away from the wireless business to a certain extent as the core business at the company, Mr. Stevenson's strategy sort of focused on that. Now will be John Stankey's company to run. Carl and Sarah did want to get that out there. I don't believe the release is out yet, but they had this virtual annual meeting, and Mr. Stevenson did share the news during the course of the meeting itself with everybody who was following along virtually.
Obviously a huge deal. The stock's been sort of jumpy, but holding on to its gains. It was up a little more than 1%. I mean, as you mentioned, David, he remade this company. It looks very different than when Stevenson took over. What do we know about Mr. Stankey, his background, and his ascent to take over this sort of media conglomerate now?
Well, listen, he's a long-time telecom executive. Of course, he did get a great deal of attention when he took over the Warner Media assets. You may recall he and I sat down the last time for an interview. When was that? In the fall, I guess, right? When I went out to L.A., when they introduced HBO Max, which soon will be available, roughly a month from now, I believe, or less. They will actually be introducing the service to a public that is certainly looking for any opportunity to consume things at home, Sarah. But he's been running that. There have been a lot of questions in terms of his leadership style, I think it's fair to say. But he's a no-nonsense guy, and he was always seen as the potential heir apparent, though, frankly, I have to tell you that when Elliott came in and started making some noise to a certain extent, there was an expectation, perhaps, that it would mean a more difficult ascension for Mr. Stankey. You heard the statement that I just read that I received from Elliott, so they are obviously supportive. And we'll see. This is an unusual time, to say the least, of course, to take the reins of one of the country's major companies at this point. We just spoke to Hans Vestberg from Verizon, talking about the wireless industry. Wireless is the least of the concerns, though, at AT&T, frankly. It has much more been on the continued erosion of the sub-base at DirecTV. And think about Warner Media right now, facing, of course, the problems that a lot of media companies do, a lack of advertising, a lack of sports on some of their key networks. HBO, however, perhaps a powerhouse, but HBO Max, that introduction, that's going to be a key for this company, no doubt about it.
Yeah, I mean, the coronavirus crisis, I know the company, David, recently came out with earnings, detailed a little more about how they're being affected, committed to the dividend, but it's an interesting time to take over a company like this where not only does he have to navigate through the crisis, and I know this doesn't come into play for a number of months, but also a potentially changed landscape for business and for media and just the way consumers behave.
Yeah, I mean, no doubt. Now, there's benefits to it, of course. Well, in terms of the need for as much robust broadband as you can possibly get into the home, and 5G wireless to the extent that that is going to be able to replace it in some fashion. Consuming as much content as we all are, given we're stuck at home at this point. At the same time, there are continued questions about, of course, the direct broadcast satellite business, what they're going to do with it, whether there is potentially value somehow that can be created there in some fashion, despite the fact that it does still generate a decent amount of cash flow. And then the wireless business. We again, coming back to Hans Vestberg, who we just spoke to at Verizon, how many people are going to be unable to pay their bill for the short term? How long is that going to go on for? How is that going to impair the company? AT&T has a very large debt load, Sarah, which you know well. And that has certainly been a key question also for the company in terms of how it manages that and how it's able to continue to pay its dividend and focus on CapEx and everything else that it needs to. It has continued to say it is just fine financially, but that has always been at least sort of an overriding question to some extent. But this does at least clear up any questions about leadership at the company. Again, Mr. Stevenson, the longtime CEO, who will remain on as executive chairman until January of 2021.
Yeah, remarkable that we have more visibility on management since they did pull their guide on Wednesday. David, thanks. We'll take a quick break here. More Squawk on the Street continues in just a moment.
Did you know with TuneIn's local radio feature, you can stream live FM and AM stations in smooth streaming quality and discover local news, talk, and music stations you didn't even know existed. Navigate to the local radio section under Browse to listen locally on TuneIn. In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening. Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen. While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn. Day 2 of the 2020 NFL Draft is on TuneIn.
Jets, that's going to be the hot spot for this draft early on, right? We're going to see if a team's going to try and get up into that spot and see if they want to pick one of these quarterbacks. And I'm watching to see where my guy Dwayne Haskins.
With round 1 in the books, there are still plenty of great players on the board waiting to hear their name called.
The only guy in this draft that has Aaron Donald potential, who's going to get up and take it? And look, I'm looking at Oakland, the Raiders, and John Gruden sat there yelling at me for all those years.
Search NFL Draft to listen.
A social distancing tip.
Putting distance between yourself and others is critical to slowing the spread of coronavirus. So here are ways to stay in contact without the physical contact part. Call, send a text, set up a video conference, post on social media, dedicate a song on the radio. If you have symptoms of fever, dry cough, and shortness of breath, call your healthcare provider before going to their office. For more info, visit coronavirus.gov.
Let's all do our...
Welcome back. Unchanged market. Dow's up 4 points. Let's get the latest on the coronavirus outbreak. Sue Herrera has some details for us at headquarters. Morning, Sue.
I do indeed. Good morning, Sarah. Good morning, everyone. Michigan's Governor Gretchen Whitmer has extended her state's stay-at-home order until May 15th. However, some businesses will be allowed to reopen, including landscapers and plant nurseries. More outdoor activities will also be allowed, like golfing and motorized boating. 1 out of every 4 American adults say someone in their household has lost a job because of the pandemic. That's according to a new poll by the Associated Press. However, more than 3/4 of those polled say they believe those jobs will return. The International Monetary Fund and the World Trade Organization are urging nations not to restrict exports of food and medical supplies. They say such moves can be dangerously counterproductive and could limit food production. Speaking of which, a string of closures of meat processing plants is raising concerns about food shortages. The Wall Street Journal reports U.S. beef production last week fell 24% from just a month ago levels by one estimates anyway. Pork production is down some 20% and poultry is 10% lower. As always, you can find more on our coronavirus coverage by heading to CNBC.com. Sarah, I'll send it back to you.
Sue, thank you. Energy, only sector that's actually positive for the week on the S&P 500, with the group ETF ticker XLE up nearly 2% over the past 5 trading days, as we have seen a volatile week for oil, the same week where we actually saw the futures contract for the current month fall below 0 for the first time ever. Joining us now is the founder of the Energy Futures Initiative. He's the former U.S. Energy Secretary, Ernest Moniz. Secretary Moniz, thank you for joining us. Good to see you again.
Morning.
I mean, the damage is certainly being done. Year to date now, we've got a more than 70% drop for the price of oil. How do you think about just how dire it is right now for the U.S. energy industry?
Well, first of all, we should make the distinction that, of course, energy is not just oil. We also do have some drops in electricity demand, for example, but certainly far less dramatic compared to the oil sector in particular, where we probably have a drop by a third in demand. Now, I do think that as the economy starts coming back, there's no reason to think that most of that demand, at least, will come back. There are certainly uncertainties. Will people shy away from public transportation? Will there be a shying away from flying as much as there was? But basically, I think there's every reason to expect a comeback in demand. But of course, for the oil industry, there's also the secular reality that over some period of time, the energy transition to a much lower carbon world will certainly continue. And that's why we also see at the same time we have the oil companies obviously worried about the very short-term issues. The large oil companies are also very actively preparing kind of new business models for the time in 1, 2, 3 decades from now, where we will see a much lower carbon economy.
In that reality, in that future, can the U.S. be energy independent?
Well, first of all, I have to say that I think the term energy independence is not exactly used, in my view, in the right way. That is, even if we were to have a net zero imports of energy required, we would still be very coupled to the world energy system. And certainly up to now, we see that obviously right now we have a big fluctuation with West Texas the oil index. But the reality is we remain very, very strongly coupled to global energy prices. Those in turn mean our economy is strongly coupled to how that goes. And so I find the use of that term energy independence a little bit misleading in that context. Now, clearly, please go ahead, Sarah.
No, it's fair. I guess I'm trying to figure out the sort of short-term pain versus what it's going to mean ultimately for this country in the long term. For instance, Treasury Secretary Mnuchin is apparently considering a lending facility for oil companies that are in need of federal assistance, according to Bloomberg. Is that something that the government should be in business of doing right now, bailing out the shale industry?
Well, I might say the government is already taking some steps. For example, the Department of Energy right now is evaluating bids for use of the unused space in the Strategic Petroleum Reserve. So that will help, if you like, take oil off the market. It may not be the full solution, but that's an example of what's already going on. I think it's, however, worth remembering that the issues with the oil sector were there well before the coronavirus came. As you know, the investor community, for example, was expressing its very strong opinion that the producers really had to start getting cash flow as opposed to running on debt, on inexpensive debt. So I think there was already a major restructuring going on, and I think as we come out of the virus, one's going to have to disentangle, in a certain sense, what are the impacts of the virus and the demand destruction in the short term versus what are going to be, in my view, going to be significant structural changes in the industry, probably leading to less production in the United States. The production, as you know, went up very, very dramatically to like 13 million barrels a day, and I'm not sure that was really sustainable in the long term.
Secretary Moniz, I want to change the discussion for a moment to the Nuclear Threat Initiative, of which I believe you're still the president. You know, it's come up in a number of conversations I've had. People concerned that we're so focused, as we should be, on the virus, but worrying that our enemies and perhaps either others with not particularly good intentions can take advantage of us through cybersecurity or concern about the prevalence of or potential for movement of nuclear weapons. I know it sounds a little crazy, but you're focused on that at the Nuclear Threat Initiative. Is it something you're concerned about?
Absolutely. The virus, for obvious reasons, gets attention. And despite the name Nuclear Threat Initiative, I should say that we have a very, very large program on biosecurity and pandemic preparedness. And in fact, last fall, we published, together with the Johns Hopkins and the Economist Intelligence Unit, we published a major report on global pandemic preparedness. And unfortunately, it proved to be quite prescient in evaluating global preparedness as pretty dismal, to be perfectly honest. Now, nuclear, and I might add another major future disruption to society, climate change. Both of those we've lost a lot of focus in the public discussion. Now, on nuclear in particular, there are major things happening right now, or that need to be decided, that are being put on the back burner in terms of public discussion. The most clear example of that is the last vestige of the major arms control architecture that this country has built over many decades, including, of course, in the Reagan administration. It's called the New START Treaty. It puts limits on nuclear weapons and delivery systems. Very importantly, it provides the last remaining boots on the ground verification program for the United States and Russia in terms of the nuclear weapon stockpile. A reminder, the United States and Russia still possess more than 90% of the world's nuclear weapons, and that means many thousands of nuclear weapons. Well, the New START Treaty will expire in February unless the essentially automatic 5-year extension happens. Our view is very strongly, and it's the view of many, including in the military, that the New START Treaty is to our advantage. The Russians have announced they are prepared to sign it. No preconditions. That is to sign an extension, which requires merely President Trump and President Putin to agree to that. Frankly, I think it's mysterious. The United States has not taken the same step. There's an example that unless something happens in these next months, 6 months, 8 months, that we will have lost a very, very important element of strategic stability with nuclear weapons. Mm-hmm. And that threat, as you basically said, that threat is, if anything, now exacerbated, even compared to the last few decades, by the risks of cybersecurity. Because our nuclear early warning systems, our command and control systems, are not invulnerable to being cyber attacked. So there's so much to do here, and it would not be to our country's advantage to sit back and not keep thinking about this.
We opened a whole can of worms there, which we could do a whole show on, but we're out of time. Secretary Ernest Moniz, thank you for joining us.
Thank you.
Trying to hold some gains here as the markets are shooting for 3 straight positive days, although the majors are on track for their first losing week in 3. We're back after a break.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening. Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen. While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
I'm Mel Kiper Jr., and if you can't watch me break down all the NFL draft picks, then listen to me with ESPN Radio on TuneIn. Just search NFL Draft to enjoy listening to comprehensive NFL draft coverage.
Is it time to rein in on market caution? One top market strategist makes the case on tradingnation.cnbc.com. More Squawk on the Street coming up.
Want to know a great way to discover the latest and greatest sports audio on TuneIn? It's easy. Just make sure push notifications are enabled on your phone to receive recommendations of sports talk radio and podcasts, along with important breaking news updates.
Hi, TuneIn listeners and NFL draft fans. This is Mel Kiper Jr. Don't forget the NFL lives on TuneIn. From the latest breaking news, team podcasts, and of course the games themselves, just search NFL and start listening today.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Get the latest breaking news alerts and listening suggestions for news stations and podcasts. Let TuneIn keep you in the loop with push notifications. Just go to your device's settings and allow push notifications from TuneIn to get live alerts and recommendations on the audio you want to know about.
Lot of clubs.
Georgia starts phase one of its reopening today, but despite giving the green light to gyms, barbers, and massage therapists to open, many are choosing not to. Equinox is among them. Harvey Spivak is executive chairman and managing director of the Equinox Group, and he joins us this morning. Harvey, it's always good to talk to you. Welcome back. Good to see you.
Thanks, Carl. Good to see you. Thanks for having me.
Tell us, what is your decision about Georgia?
So I think you got to take a step back and just look at the context of how we've been operating during the closure period. We closed, back in mid-March, and first and foremost, we focused on protecting our employees. And so unique to the fitness industry and really hospitality at large, whether it be retail or anything, any industry where you have zero revenue, most industries have stopped paying their employees. And we took a different approach. And I think it speaks to how we're thinking about Georgia as well, where we have about 65% of our employees still on our payroll. That includes our group fitness instructors and our personal trainers. And so we decided first we're going to protect our people. That was an easy decision. And then we made some of the tough decisions around reducing to only to essential spending. As we moved through that, we started really focusing on engaging our community and supporting our community. And a lot of that was through our digital efforts. And the reason why I wanted to share that first is, now we've been working on our reopening plan, and we've developed, we created a task force to work on a comprehensive plan supported by our own team of medical experts, some of the foremost experts in infectious disease and epidemiology. And so when you look at the global pandemic, it's really a localized issue. And so as we look to reopen, we'll be working with our team of medical experts to determine what's best, as well as with local government officials. In the case of Georgia, where we're permitted to open today, we've chosen not to because we're eager to open, and a lot of our writers that say at SoulCycle are eager to come back, as well as our team. We also have a responsibility to continue to embrace our high standards and not rush to open. And so we're going to take a wait and see approach, and we'll do this in all of the cities that we operate, whether it be in the U.S., Canada, or London. We're certainly going to work with local health officials, but we're also going to work with our own team of experts to determine when it's best to open, and creating the safest environment for our teams, our safest environments for our community of members or riders, as it may be, because we need to create confidence with them that it's okay to come into our clubs and our studios.
That's interesting. I mean, Harvey, we've seen examples where it's been evident your customer base can be vocal about all kinds of different things. We've seen episodes of that in the past. And it sounds like what you're saying is you're going to work on your own practices, but you will wait to hear from them about whether or not they're interested in coming back, and you're just not hearing that yet. Is that true?
Well, we're definitely going to. We're already talking to them, and they are a vocal community, and we appreciate that. It reflects on how we engage and how passionate they are about our brands. And so, we just did a survey this week of some Equinox members, and 74% said they're going to come back when we reopen. 70% were using it right before we closed. So we know there's a strong desire for our community to engage, and they trust us. So they know that we're going to have the comprehensive plan. They know that we're going to take our high standards to another level. They know we're going to be very thoughtful in protecting them and our employees. And we've got advanced things we're doing. We've got basic things we're doing in that comprehensive plan. But we're also talking to our community because we have to consider all of our stakeholders to make the right decision for everybody involved.
Harvey, it's Sarah. Outside of Georgia, how are you managing through this economic shutdown? Are you still paying your employees? Are you still paying your rent?
So, hi, Sarah. Good to speak with you. We are, largely a U.S. company, but with operations in Canada and the UK. And we continue to pay approximately 60% or 2/3 of our employees. And I'm very, very proud of that because, once again, it's so unique. And that's how we think our employees are the heart of who we are and what we do. And protecting them and taking care of them. I can't tell you how many emails and texts I've received from our employees saying, thank you that I can still pay my rent. Thank you, I can still take care of my sick parent at home who was sick prior to COVID, and I didn't know how I was going to do that. And so we made the easy decision, and we continue to do that. So in the first couple of weeks of closure, and back in March, we paid them in full. We said we'd keep everybody on health care coverage throughout the pandemic. And then starting in April, we went to a reduced compensation. It was minimal, but it was reduced so we can keep as many employees on the payroll as possible. I don't think there's anybody else out doing something like that. And that's been critically important to who we are and our future success. In terms of the essential spending, obviously, we have had to make some tough decisions. It was easy decision around employees, but it was a tougher decision on where not to spend money. And so, I think it's out there that we're not paying rent. We have great relationships with our landlords. They want to see us around for a long time. We are an important tenant because of the anchor or amenity nature, whether it be Equinox or SoulCycle. And most of our landlords actually really agree with what we're doing in terms of taking care of our people and are working with us for the future in terms of, what we do about the rent issue.
Harvey, without a vaccine for a while, can you foresee a future here where we have packed gyms as we had before this crisis broke out? Well,
for what we do, we're never packed. We serve our community a different way. And I think there's going to be even a stronger flight to quality. And I think that speaks well to our already high standards. But we're going to regulate how many people can come in our clubs or into studios or into our classes. And we'll do that largely through technology. So our app will be set up in a way where we will control how many people can be in a club at any given time. Same thing in scheduling classes. And then we're going to do many things beyond that. So we're going to control the physical distancing, and certainly we're going to encourage the continued control around social distancing. But we're going to do temperature checks. We're going to have a health declaration before people come back. So our community collaborates with us in taking the appropriate standards or precautions that they should, not just at what we're doing. We have identified innovative techniques in terms of electrostatic sprays that we'll use that have proven to kill COVID-19. We've got new hand sanitizers that have higher alcohol content that are also proven to kill COVID-19. But all of this is working with our team of health experts who are advising us on the actions we're going to take. What's most important is creating a healthy and safe environment for our employees and for our members, and we'll take whatever precautions we need to do to achieve that.
Harvey, it's David Faber. Given all that you're saying there, I would assume it's very difficult, but you have to be thinking, well, what are our numbers going to really look like in terms of customers who perhaps are willing to pay more for that kind of environment, but customers who may choose, well, this is not really going to necessarily be for me. Do you have any idea of what your roles are going to look like in terms of members come when you do reopen fully?
David, there's so much unknown here. It's hard to answer that question. I'll go back to what I said before. About 74% of our members say they're going to come back when we reopen. I mean, one of the things that we did in terms of protecting and supporting our community, we haven't billed our members since February. And we immediately put all of our members on freeze at no cost, even though typically if you freeze, there's a fee associated with it. We believe over time, most of our members will come back, but we also need to address their concerns and their fears. So we're not going to, once again, rush. We do believe that there'll be challenges between now and vaccination or when other therapies are available that people feel more comfortable. But we also believe that when we get on the other side of that, there'll be more demand for who we are as Equinox or SoulCycle than ever before, because there'll be a flight to quality from the consumer, there'll be a flight to quality from the talent, and that all speaks well to who we are and what we do and where we're going. So I think the future has never been brighter, but there's this interim period, and we don't know how long that interim period is going to be, where it's going to be, challenging and lots of unknowns. And, we've proven that we can adapt quickly, and we'll continue to adapt. The perfect example of adapting is what we've done with our virtual personal training. We didn't have virtual personal training before we closed, and now we have 65% of our trainers engaging with their clients in virtual personal training, and we have 3,000 trainers. So we'll continue to adapt as we need to, but clearly there's a lot of unknown in the coming weeks and coming months.
Finally, Harvey, is it too simplistic to argue that a gym might come back before a room full of bikes where you take a class?
Look, I think it depends on how you operate. And so part of that is, I think in our environment as Equinox, we can do things that others maybe can't afford or won't think about doing. I talked about some of the advanced practices. Obviously, we do basic things, which goes without saying in terms of the type of cleaning and what have you. But I think we can control environment there. And I also think we can control environment in studio. So by way of example, at SoulCycle, if a typical studio might house 60 people at capacity, that studio will have 20 people in it for a period of time. And so we'll regulate, once again, the number of people, the density of our clubs and our classes to create a safe environment, and also to make sure that our teams and our members and our writers feel safe. We need to build that confidence in them, and that's what we're committed to doing.
Harvey, appreciate you coming on and sharing that with us. Always good to talk to you. Harvey Spivak of the Equinox Group, as we do keep our eyes on Georgia. And David, now our eyes on the president's Twitter account as he comments on Randall Stephenson. Great news. The CEO of heavily indebted AT&T, which owns and presides over fake news CNN, is leaving or was forced out. Goes on to say that hopefully the replacement will be much better.
Yeah, I guess he's focused on that. Interesting. Of course, as we have said, this is not a surprise that Mr. Stephenson is stepping down. He's given every indication that this would be his last year at the helm of AT&T. And John Stankey was presumed to be at least the front runner to take over, and will be, of course, taking over the job as CEO come July 1st of this year. And I'm sure that many of the shareholders share the president's sentiments, Carl, that he will be better than his replacement, so to speak, in the sense of at least creating more shareholder value.
But David, there's a history here, right? President Trump's Department of Justice tried to block the merger of AT&T's buyout of Warner Media. Obviously wasn't successful, of Time Warner. And, part of the argument, I guess, that the company had, right, was that the president was interfering. I mean, this has been sort of a long-running thing.
It has. And by the way, it's interesting because Mr. Stephenson's politics are not exactly to the left. I think I can say that. But nonetheless, the president has been focused on this company in part because of its ownership of CNN. He was focused on Time Warner prior to that. And as you say, Sarah, it was a very much unexpected opposition from the Department of Justice, given the nature of the deal was a vertical merger, not a horizontal one, that they would oppose it. Ultimately, they went to court, Judge Leon ruling in favor of the company, allowing them to proceed with the deal. But the interregnum, the amount of time that it took, certainly hobbled AT&T in terms of its integration with Time Warner, and was something that they look back on, I think, with regret in terms of how long it took. But you're right. There is no shortage of antipathy for the president, for any of his enemies, as he, of course, sees CNN as being one. And now Mr. Stankey is going to be having to deal with that as well.
AT&T shares, by the way, still higher, up about 0.2%. With many Americans now having to work from home, what changes should they be expecting when they actually do return to the office? Jane Wells has been looking into that story for us. Morning, Jane.
Hey, Sarah. Yeah, when we do have to go back to work, I've talked to a couple of office designers about what may change. Now, you're going to see video of what CNBC headquarters looks like right now as most people work from home, but designers are starting to talk to clients about what's next. In the short term, you may see teams divided of employees, which come in on different days and sit at different desks. Rendering suggests more space per worker, one-way foot traffic. The high-walled cubicles will come back. Communal hangouts will go out. And what about the conference room?
I would say that conference rooms are probably off limits for a while. I think even though we might be under one roof, we're probably still going to be doing Zoom meetings.
And what about the bathroom? So maybe you can open the door with your elbow and have touchless soap dispensers, touchless sinks for washing, even hands-free towel dispensers. Then you come to the toilet stall, traditionally not hands-free.
There's ways that you can open even toilet partitions with your foot, thinking through what things are cleanable, where you use grout and where you don't. So there are ways that we can start thinking through even incorporating voice activation to open doors and the like that will make it an easy experience.
Toyota said on its conference call it's going to put plexiglass between bathroom sinks and discourage people from using the elevator. And guys, we may see the return of the elevator operator who touches all the buttons for you. Back to you.
That is wild. And a lot of thought, obviously, being given to that. Jane Wells, thank you. We'll send it now to Rick Santelli over in Chicago. Rick, good morning.
Good morning. Thank you, Sarah. I'd like to welcome my guest, Jane Sorensen, President-elect of the National Pork Producers Council. Jen, we're short on time. Let's get right into it. Not only do we lose restaurants in the pork business, but now processing plants are closing due to coronavirus infections, and we're seeing potential shortages of pork. Tell us what's going on.
Yeah, you hit the nail on the head, Rick. We are definitely in extreme peril right now as U.S. hog farmers. We've lost 25% of our market to restaurant closures, and unfortunately, due to COVID-19 and worker absenteeism, we're losing packing capacity too. Hogs are backing up on our farms, and we are bleeding money. We're losing so much capital. In fact, our swine economists tell us we're about to lose about $5 billion as an industry collectively for the rest of this year, and that for a hog farmer means about $37 per head, which is a lot of money. So now, Jen, a lot of fear going on.
Jen,
right
what
now
are your suggestions? What are your suggestions in the big picture, how to get these things back online? Much of it is absenteeism due to fear of coronavirus, which we all can understand. I hear the governor has some plans for tests. How's that going to go?
You know, we've seen a tremendous amount of resources go into keeping the plants open, keeping them open and keeping that line speed going. A lot of PPEs, a lot of dividers, a lot of extra communication, hazard bonuses. I know the governor here in the state of Iowa has done a tremendous job into, mitigating that risk, but it's a big concern for U.S. hog farmers right now in terms of what that closure means to us and backing up our pigs.
And very quickly, even though phase one is done with China, obviously coronavirus has changed many things. What about the export market? Finish us off about the potential to save part of the industry through exports.
Yeah, I mean, COVID-19 has an impact around the entire globe right now, and our exports, unfortunately, are slowing down. And the U.S. is dependent on an export market. In Mexico, for example, stay-at-home orders and labor-related trade logistic issues are slowing down exports. In China, we have such a phenomenal opportunity to export more pork into China.
All right.
But
Jen, we're out of time. We have a hard break. We will get you back after we get more information on this. Thank you for your thoughts on the future of pork. And Carl, back to you.
All right, Rick, thank you very much. Rick Santelli. Good Friday morning, everybody. Welcome to Squawk Alley. I'm Carl Quintanilla with Morgan Brennan and John Fort coming to you live from various locations as we're in a narrow range today. Dow going back and forth between the green and the red, shooting for 3 straight days up, although we'll be looking at its first down week in about 3. Big news of the morning, though. David Faber brought us first about an hour ago that Randall Stephenson of AT&T will retire on July 1, remain executive chair until January, and John Stankey will succeed. This will be a story that we're going to watch very closely here as the succession happens, David.
Yeah, it's not unexpected, of course, Carl. It was done in somewhat unexpected fashion, given so many things that are different right now. AT&T was having its annual meeting. It was doing it remotely, virtually, and Mr. Stephenson announced it during the course of the annual meeting that, as you said, he will be stepping down at the end of June to be replaced by Mr. Stankey as CEO. Mr. Stephenson will remain on as executive chairman of the company until January of next year. Stankey will step up, of course, and become a member of the board of directors immediately upon taking the role of CEO. Now, again, he is president and COO of AT&T. He got that promotion a number of months back, if you recall, but there have still been questions in terms of whether he would actually get the top job, whether the board of directors would support him for that. Mr. Stephenson had made it clear that he was going to leave the company as its leader, most likely this year, and obviously choosing to move forward with that despite the current crisis. His 13 years at the helm of the company, of course, have been marked by his acquisitive nature. Remember, he wanted originally to acquire T-Mobile, a huge horizontal deal that was actually stopped by the Department of Justice, and came in for a good deal of criticism, in fact, by shareholder Elliott Management earlier this year, saying and reminding people of the $5 billion in value that was delivered to T-Mobile, both through Spectrum and through actual monetary penalties that AT&T was forced to pay when that deal, many years ago at this point, was stopped. The acquisition of DirecTV, which has been a difficult one in some way, added a good deal of cash flow to the company, some saying enabling it to make sure its dividend was secure, but at the same time, the erosion of subscribers at these direct broadcast satellite companies is well known. And then, of course, the Time Warner deal that Mr. Stephenson oversaw as well, transforming AT&T into far more than a wireless company or delivery of satellite video, but into one of the larger entertainment providers in the world. The launch of HBO Max will take place fairly soon. I did sit down with Mr. Stankey at the end of October. We were in Los Angeles when they unveiled HBO Max, and I did ask him about his desire for the CEO job. Do you want to become the CEO, and do you feel the pressure to actually perform over this next period of time in terms of what we're talking about here in order to potentially ascend to that job?
You know, I've been working for 34 years, and I think in virtually every job that I've taken, I've always felt a pressure to perform and actually add value back to the business. I don't think that changes or I feel any different about that. I've got a lot in front of me to do right now. This introduction of this product is incredibly important. Every job I've come into, it's always been what needs to change, what's something that can add value to the business, and how do you focus on doing it well. That's what I'm going to do right now, and that's all I'm concerned about right now. What comes from it comes from it. The beauty I have is I have this wonderful luxury in my life that I really don't have to work. I work because I want to work, and that's a blessing. It's a blessing for me, and I'm here because I want to do this, and I want to do what's in front of me right now.
Well, he's got a lot in front of him right now, as you guys well know, of course, with that large debt load continuing at the company, with the erosion of subscribers at DirecTV, though perhaps has peaked at this point, and with continued questions about the Warner assets and the important launch of HBO Max, which is coming up very quickly, priced at a fairly high point. Some in the marketplace wondering about that, although the current environment may certainly be very conducive for it. So John Stankey taking over July 1st. Carl, as CEO of AT&T, Randall Stephenson, 60 years old, stepping down after 13 years. Stankey, by the way, 57.
David, certainly news of the morning and something that even President Trump has been weighing in on Twitter just a few moments ago. But I'm curious about Elliott Management's role in all of this. Obviously, they've come out and pushed for executive changes at AT&T. Says today that they, quote, support Stankey as the company's next CEO. How do you think that factors into what the priorities look like as he takes the helm in a couple of months?
Yeah, it's a great question that you ask, Morgan. You know, there are some who wonder, well, if Elliott is on board, as they are, and remember, I read a statement from them, which I'm trying to access again here, but basically saying they were supportive, that there was a significant search undertaken by the board of directors. But we do wonder, you know, what in particular is going to be the future of DirecTV? Is there something that the company can do there to potentially create value? Unclear. There have been plenty of rumors in terms of what they might be able to do. But when you go back and look at the original letter from Elliott, they certainly had a lot of suggestions for the company at that time. Now, they did it wasn't an official settlement. They did sort of come to a broad agreement, Elliott signing on for what they had decided to do in terms of potentially taking costs out of the business and addressing what they said was the operational underperformance overall. But what it means with his ascension and Elliott saying we're supportive of it and what's to come, unclear, but certainly some reporting to do there.
I'm looking at the broader picture here, and Randall Stephenson, if I'm not mistaken, became the CEO of AT&T right at the beginning of the smartphone era, right around mid-2007. I would argue that largely defined his time, and he came up in AT&T through the CFO track. John Stankey, interestingly, came up through the CIO, CTO track, and now we've got content and 5G looming as challenges. Those will probably be pretty important, at least in the early part of his tenure in defining the job, won't they?
Yeah, they will. And certainly 5G, of course, is a key cycle right now that they're in the midst of. AT&T having reported earnings, at least giving some sense that, you know, permitting problems in the current environment may slow things a bit. But, John, it's funny for me because the company has talked so long about diversifying. Remember, and some of us saying almost running away, I would say that, and some others would, from its wireless business. Not fair, perhaps, to say that, but certainly diversifying away from the wireless business. And yet, that's what they've come back to when they talk about creating value at the company right now, the strength of the wireless business. And we'll see what happens right now, given the inability of people to potentially pay, whether or not they're going to be hindered in any way in rolling out 5G across the country, whether the devices are going to be able to get in the hands of consumers so that they can use them. All questions that Mr. Stankey is going to be dealing with. And remember, Jason Kilar was put in to take over Warner Media very recently as well. So he's got that squared away in terms of leadership.
All right, David, thanks for that. Our David Faber on Stephenson and Stankey, that succession at AT&T. Getting some breaking coronavirus news this morning. For that, we're going to turn to Sue Herrera. Morning, Sue.
Good morning, Carl. And this concerns a study that was done and published just now by the Journal of the American Medical Association. And basically what it is saying is that the treatment of COVID-19 by hydrochloroquine and chloroquine should only be done in a hospital setting. The study that was done basically has raised some questions about the efficacy of the use of one or more or the combination of those drugs. This has triggered, basically it was a bad outcome in this study. The primary outcome in many patients was death. Now, that has triggered an FDA response. The FDA is saying, do not use hydrochloroquine or chloroquine for COVID-19 use outside of a hospital setting. They have been shown not to be effective for treating or preventing COVID-19. Hydrochloroquine and chloroquine can cause abnormal heart rhythms such as QT interval prolongation. The QT is measured on an EKG. It measures the time that it takes the ventricles in the heart to contract and then relax. The combination of those drugs, especially if it's combined with azithromycin, lengthens that time. And for patients that have underlying heart issues, that is not good, to say the least. Basically, they say it also can cause a dangerously rapid heart rate called ventricular tachycardia. These risks increase when the medications are combined with other medications that prolong the QT interval, such as the antibiotic azithromycin, which is being used in some COVID-19 patients without FDA approval. Patients also with other health issues such as heart and kidney disease are likely to be an increased risk of these heart problems and death. So basically, it's a big warning by the FDA. The study by the Journal of the American Medical Association did not show good results for either one of those drugs or the combination of those drugs with azithromycin. So we're going to watch and see what happens, but not good news at this point. Morgan, I'll send it back to you.
Sue Herrera, thank you for the latest. For more on the markets, we're going to turn our attention back there. We're joined on the CNBC Newsline by JP Morgan Asset Management's Phil Camporeale and Morgan Stanley's Chetanaya. Thank you both for joining us this morning. Phil, I'll start with you. Just taking a look at the market, the S&P specifically, the fact that we've been pretty range-bound, not only today, but in recent trading sessions after we quickly saw it retrace 50% of its decline. Where do you see it going from here, and what do you see as the biggest potential catalysts? Is it still medical headlines like the ones we just got a moment ago from Sue Herrera, or are there other pieces, other factors that are going to continue to drive the market action?
Yeah, Morgan, good morning. Greetings from the great state of New Jersey. So, when we, as asset allocators, we made a very, very sharp move by taking our equity allocation in our multi-asset portfolios down by about 20% by mid-March. That was a very bearish stance. At this point, though, Morgan, we're not leaning nearly as bearish as we were back then. And I think that while still underweight, we've replaced almost 50% of that risk. And, I think it's driven by the confidence around policy. We've spoken a lot about it. The Fed stopped LIBOR from increasing. Corporate debt is starting to act really well as a good diversifier. Congress has responded much, much more than what people were expecting through small business loans and unemployment insurance. And I think that's what's being digested by the markets through what you were just talking about in terms of being range bound. That, the question now remains, what is the right multiple for the market given this extraordinary policy response, right? And we are assuming in our base case that Q2 will mark the low point in economic activity in this crisis. And I think that's why you shouldn't really lean as bearish. And we're taking our cues really now in this kind of final part of the staggered reopening of the economy. And I'll also remind you with the stock market, there is a historically compelling dividend yield versus where fixed income is right now. Treasury rates so low, that worked in a major way in the last cycle. And I think we're going to continue to point to a tailwind on stocks being so compelling versus debt. And the last thing I'll say is just as asset allocators, we need to think about the right defense. And that's both government bonds and investment grade credit right now. Investment grade credit is yielding 2 to 3% over treasuries right now.
Yeah. So just to follow up on that, what is the right multiple for the market right now? Where do you put it?
Yeah, so we're doing the same calculation everybody's doing. If you see a material reduction in earnings, that's worse off than where we were in the beginning of the year. But what we are getting, okay, is the Fed is basically buying anything that's not nailed down. If the Fed walks into your store, prices are going to go up. So, I think that the average multiple of 16 times that we've seen over multiple decades is probably too low in this environment, even with the material reduction in earnings and growth. I think the market is kind of looking through that. They're expecting that. That's why we had the policy response. And I think the multiple should be higher than long-term average in the near term, given this just extraordinary historical wartime spending from Congress and the Fed really buying everything that they possibly can to stabilize capital markets.
Morning, Chetan. I want to go back to this headline that we just got on hydroxychloroquine, and because it's something that the president had touted as a game changer, and now the scientific studies are showing that the primary outcome from taking it can be negative outcome can be death. Do you expect any market reaction from that, or are we mostly looking at things like the amount of testing that's available, whether it is virus testing, antibody testing, and the ability to get back to the economy opening up in various states?
Yeah, I think the market is probably going to be focusing more on the staggered opening that we were discussing earlier on. So that's basically watching, how the states are beginning to reopening. I think the rule book right now for the market is still to look at what had happened in China. So once the number of new cases peaked out in a few weeks, you started to see actions being taken to reopen. In White House's guidelines, if you take that into consideration, 14 days after the new cases peak and they are declining, you will see opening of several states. And so we are actually looking at 28 days, not 14 days, because the phase one is not so meaningful opening. But in 28 days, we would probably, if you take the data on the new cases peaking out, by middle of May, you would have about 48% of GDP. The states which are accounting for 48% of GDP will begin to see meaningful opening if we take that guideline as well as the data on new cases into consideration. So I think the market is probably going to be more focused on that. And if there's anything that indicates that new cases are not peaking quickly or not rolling down, that will be a bigger factor weighing on markets' mind than the news flow on therapeutic drugs.
So, Chetan, just to dig into that a little bit more, I know one of the things you've written about recently is reopening in China and what economic activity has been looking like there. How much of what we've seen take place in that country can actually be applied to the U.S. and also parts of Europe where we are starting to see these reopening plans emerge?
So we are seeing a lot of similarity. Actually, the only difference is that the scope of the outbreak in Europe and in the U.S. has been much bigger. So we are kind of observing that all the activities in terms of reopening, etc., is lagging China by about 3 months. That is that China started to see the outbreak a bit earlier, and then U.S. and Europe has had a wider scope of the outbreak. There is a lot of similarity and things which we are learning, and we are seeing something similar going on in Europe. So we think the global economy is going through a rolling bottom. China's data bottomed in Feb. Europe is bottoming in April, and the U.S. will also bottom in second half of April. And then we are going to see opening of most of the places or several of the parts of U.S. and Europe in the month of May. So the economic data will be recovering from month of May for U.S. and Europe. So it's pretty much following the China track with a different level of lag because of the scope of the outbreak.
All right, Phil and Chetan, thank you.
Markets trying to stay out of the red today. When we come back, we'll talk to Bob Swan of Intel on the heels of their earnings and their guidance, which was kind of nice to get in this environment where so many companies have pulled. Back in a moment.
I'm Mel Kiper Jr., and if you can't watch me break down all the NFL draft picks, then listen to me with ESPN Radio on TuneIn. Just search NFL Draft to enjoy listening to comprehensive NFL draft coverage.
Did you know with TuneIn's local radio feature, you can stream live FM and AM stations in smooth streaming quality and discover local news, talk, and music stations you didn't even know existed. Navigate to the local radio section under Browse to listen locally on TuneIn.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
It's TuneIn Sports on this day. On this day in 1978, Angels pitcher Nolan Ryan strikes out 15 Mariners. The 20th time he struck out 15 batters in a game.
He's one strike away, and these fans now are cheering for Nolan Ryan. 41,411. They'd like to go home saying, I saw my first one.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history.
There it goes, 3-2 pitches, hit in the air and hit well. Center field, Bader back, at the wall, it's gone!
Search classic game replays to relive some of the great contests in America's pastime.
Ground ball out to Jackie Robinson, up with it, over to Reese for one, back to Hodges, it gets away from him, Barris trying to go to second.
It's on demand, it's free, and it's only on TuneIn.
Hey everyone, it's Tremaine Lee, MSNBC correspondent and host of the new podcast, Into America. In our latest episode, Republican giant and longtime Senator Lindsey Graham is for the first time ever facing a real challenge to his Senate seat. Can a relative newcomer to the scene, a black Democrat in a red state, win this fight? I head to South Carolina to find out. Search for Into America wherever you're listening right now and subscribe.
Get yours.
Intel shares are under pressure, down about 2% after earnings. We've got analysts lowering price targets, raising price targets, maintaining. We're going to talk to CEO Bob Swan next. Stay with us.
You love TuneIn for live-breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search classic game replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
Did you know with TuneIn's local radio feature, you can stream live FM and AM stations in smooth streaming quality and discover local news, talk, and music stations you didn't even know existed. Navigate to the local radio section under Browse to listen locally on TuneIn.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
A social distancing tip.
Keeping your distance from others is important in slowing the spread of coronavirus. So here are some fun things to do alone. Read a book, take a walk, unpack your suitcase from that trip you took last September, paint a self-portrait, catch up on a TV series, do a puzzle. Remember, we should all stay home to lower the risk for everyone. For more info, visit coronavirus.gov.
Let's all do our part, because we're all #AloneTogether. Brought to you by the Ad Council.
Hey everyone, it's Tremaine Lee, MSNBC correspondent and host of the new podcast, Into America. In our latest episode, Republican giant and longtime Senator Lindsey Graham is for the first time ever facing a real challenge to his Senate seat. Can a relative newcomer to the scene, a black Democrat in a red state?
A beat on the top and bottom lines has not been enough to keep Intel in the green this morning. The company is one of the few to issue guidance this earnings season, saying the current quarter is tracking just below the street's estimates. Lots of questions on gross margin here, as different analysts interpreting that different ways. Joining me now, as he tends to, first on CNBC is Intel CEO Bob Swan. Bob, good morning. Great to see you.
Good morning, John. How are you today?
I am doing well. I'm thankful that you are too. Let's start first with a broad look at this quarter and where Intel is. Tell me about the workforce. How stable is it? Your partners and customers. Where is demand? Do you see a way out of this crisis that we're in?
Yeah, thanks, John. Well, first, let me just start with the quarter we just closed. Really, it was an outstanding quarter for our company. 23% top line growth. Our operating margins expanded by 10 points. Our earnings grew over 60%. So all in all, in the first quarter, it was even better than we expected when things started out. What we saw during the course of the quarter was, one, the resiliency of our workforce. We started out when the COVID-19 began by really focusing on the welfare and the safety of our employees, first and foremost. Secondly, ensuring that we were delivering for our customers, because in so many ways, they were counting on us more than they ever have. And third, as you and I spoke last time, giving back to our community in these troubling times. So through the course of the quarter, our global supply chain delivered more than we expected for our customers, and our employees are safe. And we go into the second quarter having raised our outlook for revenue on the top line. So far, so good to the first half of the year. As we go into the second half of the year, things are just too cloudy for us at this stage to really give a really good insight about what to expect for the full year.
Right.
But through the first 4 months, performing extremely well. in incredibly challenging circumstances.
Now, a number of people are scratching their heads about the gross margin guide for Q2, 56%, down 6 points sequentially. Now, you did explain this on the earnings call. You talked about three primary reasons for that. But I want to try to highlight what mainly this is, because the move to 10 nanometer and the way that Intel manufactures, I think even a lot of investors aren't so familiar with that. Is this 56% gross margin because you're putting your foot on the accelerator with the transition to 10 nanometer even during this difficult time?
Yeah, John, it's really two things. I mean, first, in the first quarter, our gross margins were better than expected, so that's good, solid foundation. But the two things that are compressing gross margin in the second quarter is, number one, our excitement around the qualification of a product that we will deliver in the third quarter. And so what that means in the second quarter, until that product's qualified, is all of our expenses flow through to the P&L, but that comes back in the second half of the year. The indication there is good news. We're on track to qualify a product in the third quarter that will be a very good product for the industry, which is our second generation 10 nanometer product for the PC. The second thing is we're increasingly confident in our 10 nanometer node, and therefore with that confidence on how yields have been performing in our factory network, we're going to go even faster, both on the PC product and on a 5G SoC product that we're launching as we go into the second half of the year. So we're qualified in a wonderful product, and we're accelerating the volume we're putting on our 10 nanometer platform. So normally I don't consider gross margin compression as a bad thing. But in this case, for both those reasons, the compression of gross margin in the second quarter is a good thing. It's timing oriented for us, and it's confidence in rolling out our new process node faster than we anticipated.
Okay, I think that clarifies for some people and makes some sense. I want to get into the PC now and understanding how that's been affected by this. You, as a former CFO, and George, you kind of have a reputation for being conservative in guidance, so I want to try to parse that. Not that that's a bad thing, but your guidance on the PC segment, flat to up slightly, based on the demand that you're continuing to see in cloud, in service provider. It seems to me like part of what's driving that is the same kind of demand that's driving the PC business. So why is the guide on PC flat to up compared to the stronger guide for the other segments?
Yeah, it's a great question, John. I mean, first, in the first quarter, our PC business grew by 14%. So the end market demand that we're seeing in the industry really strengthened during the course of the quarter, and particularly in March and the latter parts of March. So the end market demand is relatively strong. The challenge in the supply chain during the course of the quarter is we were able to ship in to our ODMs and the OEM customers that we have, but they had to ramp back post-Chinese New Year to get back to full production. So what's happened, we had a very strong first quarter. It's gone into the supply chain, but it hasn't gone into end market consumption. So a strong 14% growth in first quarter, a roughly flat growth in the second quarter in the aggregate, has consumption in high single digits, which I think is stronger than everybody in the industry anticipated when we came into the year. The real question, so demand stronger, supply chain working through the inherent challenges caused by COVID. The real question for us and for the industry is, what are the longer term implications for the current environment? Will it mean more and more demand for PC and peripherals in the home going forward? Or is this a temporary spike in demand that will normalize over time? And that question hasn't been answered as yet.
What do you think? Because I think that a number of people are recognizing that the PC is a piece of essential equipment. If you got an aging one at home and you kind of thought, well, maybe I could let it go, I'll use a tablet, I'll use my smartphone. Now you're thinking, hey, the kids are going to need that for school. I'm going to need it to get work done. By the way, I might need a webcam. I absolutely have to keep that updated. Could we see a shift in refresh cycles, not just initially, but a compression of them going forward based on that? And when will you know?
Yeah, it's that's the question. Maybe three different answers. In the real near term, which is what we experienced in the first quarter and the second quarter, there was a spike in demand for the needs to allow us to work from home or to study from home. So in the real short term, we saw a real spike in demand. Over the long term, I believe that will continue. The PC as an essential component of everyday life, I think, only gets greater over the long term. That bodes well for the industry. That bodes well for Intel. The challenge is going to be in this medium term, really, as unemployment has gone up dramatically in a relatively short period of time, as global GDP has compressed quite a bit in a very short period of time. The question right now is more this near term. What is going to happen in the second half of the year? And while we feel very good about the first half, while we feel very good about the importance and how essential the PC will be going forward, it's this temporary period in the second half where we just don't have great visibility yet.
Right.
But it was 40 years ago where the industry, Intel and the industry, talked about getting a PC in every home. Now I think more the presumption is, as we continue to deliver great technology in a world where the PC is even more essential than ever, can we have not just a PC in every home, but a PC in every room in every home?
Right. And finally, we'll try to make this quick. I want to ask you about the company. When California does greenlight a return to work, is Intel going to redesign workspaces? Is the era, you think, of high-density, open-plan offices over? Are you starting to think about that yet?
We're starting to think about it, but we haven't quite resolved it. I think right now our priorities, as you and I spoke last, are the health and welfare of our employees first and foremost, delivering for our customers and helping our community in these trying times. And what that means for the office environment, for sure, distancing will be a more important ingredient in working in the office, and we'll figure what the right solution is over time.
All right, and you're showing us in your shot that the sun is coming out in California. We will take that metaphorically as a good sign. Bob Swan, CEO of Intel, thanks for being with us.
Thanks so much, John.
Good stuff, John. Thank you. Shares of Intel are down about 2%. We're going to take a quick commercial break. Just going to check on the markets real quick before we do. The S&P sliding or slipping between gains and losses, really hovering near that 2,800 level, though. Similar story for the Dow, which is down about 76 points. Stay with us.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
I'm Mel Kiper Jr., and if you can't watch me break down all the NFL draft picks, then listen to me with ESPN Radio on TuneIn. Just search NFL Draft to enjoy listening to comprehensive NFL draft coverage.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
Wondering what to play next? Want to know what other TuneIn listeners are listening to right now? Head to the trending section under Browse to explore the most popular stations and podcasts on TuneIn today. Millions of listeners like you can't be wrong.
A social distancing tip.
Keeping your distance from others is important in slowing the spread of coronavirus. So here are some fun things to do alone. Read a book, take a walk, unpack your suitcase from that trip you took last September, paint a self-portrait, catch up on a TV series, do a puzzle. Remember, we should all stay home to lower the risk for everyone. For more info, visit coronavirus.gov.
Let's all do our part, because we're all #alone together. Brought to you by the Ad Council.
Not all heroes wear capes, but most wear tights.
And here we go. Now it's underway. Cover on Rowan. Wins.
Keep up with everything happening in the wild world of pro wrestling with a TuneIn podcast. For expert analysis of...
Welcome back. New York State out with its latest numbers on COVID-19. Here's Governor Andrew Cuomo just moments ago.
Total hospitalizations down. Good news. 14,200. All the evidence suggests we're on the downside of the curve. We're headed down. Net change in hospitalizations is down. Net change in intubations is down again. And they have been down for a while. This is still not great news. Number of new people coming into the hospital, number of new infections is slightly down, but that's basically a flat line, and that is troubling. About 1,200 new, 1,300 new infections every day. Number of lives lost is still heartbreaking news, 422. Again, this is at an unimaginable level, and it's dropping somewhat, but it's still devastating news.
We'll keep our eye on the briefing there by Governor Cuomo. Of course, in recent days, it's been not just so much about the data, but some of the secondary stories he's brought us. For instance, that serology study from yesterday. In the meantime, as states begin trying to reopen their economies, the nation's labor unions worry about worker health and safety. Joining us this morning is Dee Taylor, president of Unite Here, a union representing more than 300,000 hospitality workers in the U.S. and Canada. Dee, good to have you. Thanks for joining us today.
Morning. Thank you.
We're definitely seeing pockets of concern regarding worker safety, and now Vegas has turned out to be this sort of flashpot of what to do, whether it's comments from the mayor, comments from the Las Vegas Sands issuing playbooks on how to open. How would you characterize the interest in going back to work in Vegas specifically?
Well, in Vegas specifically, we're not going to be wrapped in a laboratory like the mayor suggested. When we reopen, we want to make sure scientists and health experts are in the middle of that decision making. But we also want to be part of how it reopens. We want to insist on testing, PPE, hand sanitizers, cleaning to CDC standards, enforcing social distancing, and give us our health care for those who don't have health care, because we don't think anybody should have to choose between your life and your job.
So how much distance do you think there is right now between the status quo as it is? I mean, if we had to open today, and the kinds of precautions you want to see in place, your union wants to see in place when, in fact, things do reopen?
Well, the Wynn Resorts released what they thought the cleaning and the safety protocols are. They did that last weekend. We're very encouraged by that. We think companies should follow that. We do think testing should be involved, too, besides heat sensors, hand sanitizers, PPE, and CDC standards of cleaning. We're going to be involved with this, not just in Las Vegas, but throughout this country, because we're not going to have our workers and the workers in this industry, whether they're represented by us or not, be viewed as rats in a lab that get tested whether the precautions have been good enough. We're going to do everything possible to make sure that the people in the hospitality industry are protected.
Dee, I realize that your union represents hospitality workers. That being said, there are already real-life examples of workforces, unionized workforces, that are still operating in factories, still operating facilities, still showing up to work every day, whether it's the defense companies or transportation, logistics, the auto workers that are making things like ventilators and PPP right now. Are you having conversations with some of those other unions about what you'd like to see in place, and how closely are you tracking that?
Yes, we have been in conversations. We've also been in conversation with health experts, independent of any company. We've also been talking to the companies. I think the companies realize this in our industry. It's not just about worker safety. If guests don't feel like they're safe, they're not going to come into those establishments. So this is about not only the workers, but the actual clients and the guests. It's for both. And anybody who doesn't see that doesn't understand our industry. And the kind of comments that were made by the mayor, for example, in Las Vegas are completely irresponsible. And frankly, I think they're immoral, because not only are you putting workers in jeopardy, you're putting guests in jeopardy. And that is the death knell of any hospitality business if guests do not feel like they're safe.
Absolutely. When I see a stat like over 95% of Unite Here members in the U.S. and Canada are either laid off or furloughed right now, I mean, we're talking about workers that pay dues to the union every year. How are you helping them financially? And what does it mean in terms of the union's own financial viability in the coming months?
Yeah, I mean, we're helping them in several ways. I feel good that most of all of our union members have extended health care because of our health care funds. But I'm not just thinking about our members. I'm thinking about people in the hospitality industry, the 26 million people who millions of people have lost their health insurance. I think Congress has been completely irresponsible. They've just spent over $2 trillion in the healthcare crisis and not figured out how to extend healthcare to people who need it the most. It's criminal, in my opinion, what Congress has done. Number two, we're helping in the unemployment system. The unemployment system in almost every state is unbelievably dysfunctional. Florida being the worst. 1.5 million people have applied for unemployment in Florida, and only 40,000 people have been applied. That's a level of incompetence or deliberately denying people the kind of health insurance, the unemployment insurance. Number three, we're helping people with food. We've set up food banks. Food insecurity is a huge issue. We have an ongoing one here in Vegas. We just did one in Atlantic City. We've done one in Los Angeles, et cetera. Food insecurity. Four, shelter. There, as you know, we have some predatory landlords who try to want to evict people. We are in the middle of that 100% because the last thing we need is people out on the street due to this situation right now. And then finally, we are urging in the strongest possible ways that those millions and millions of people who have lost their jobs recently, no fault of their own, we have got to figure out health care for those workers. Congress has not stepped up. It's criminal, and they have got to step up. I'm well beyond our industry, well beyond our membership. That has to happen.
Dee, speaking of no fault of their own, Larry Kudlow this morning talked about the White House looking at the issue of liability protection for small businesses to protect them from lawsuits in case a customer or employee gets coronavirus through no fault of their own. He says, I don't think there should be a lawsuit. What's the balance there? Because small businesses that are buried in litigation are no good to themselves or their employees.
Yeah, listen, I'm very supportive of small business. I think that first round of loans where big corporate ones got it was outrageous. I'm glad we've embarrassed them. I'm glad we've embarrassed them to return some of that money, like at Ruth Chris. On the other hand, let's make sure if they are talking about litigation, what kind of safety procedures those companies are doing to ensure the workers and the guests are in the best possible position not to contract it at work, and also to have an environment where people are tested and checked before they come to work, at least the very first time. So you can't say one without the other, in my opinion. He talks about the liability. He doesn't talk about the safety protocols that every business should actually be mandated to do before they reopen.
Finally, Georgia is going to be a big test case over the weekend. We've talked a lot about it this morning. How much exposure do you have to Georgia right now? And are you getting the sense that workers in the union are anxious to go back to the degree they can?
Well, it's not just Georgia. That's the whole country. It's not like the virus stops at a state line. So if somebody's in Georgia and they travel to New York or they travel to Texas or Louisiana, it's not like it stops. So Georgia, in my opinion, is being completely irresponsible to the rest of the country. That's one. Our workers, nobody's more anxious to go back to work than our members and folks in the hospitality industry. They want to go back, but they want to go back to a safe environment where they're not risking their lives. Like, I think there's an old English highway robber statement they used to go to the carriages. Give me your life or give me your money. Well, everybody always chooses their life over their money. We shouldn't go back to those days. Let's allow people to have their life and their health and earn money at the same time.
Dee, we appreciate you sharing your thoughts. We hope you'll come back. A huge issue for the American workforce as we try to figure out how to unlock this puzzle. Dee Taylor.
And now we're going to take a quick commercial break with the major indices all just about flat. Stay with us.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn. Whenever you're unsure of what to play next, head to the homepage and discover something new. There you'll see custom recommendations based on your listening habits, along with new episodes of shows you've enjoyed in the past. Uncover your next audio obsession on the homepage.
I'm Mel Kiper Jr., and if you can't watch me break down all the NFL draft picks, then listen to me with ESPN Radio on TuneIn. Just search NFL Draft to enjoy listening to comprehensive NFL draft coverage.
Hey everyone, it's Tremaine Lee, MSNBC correspondent and host of the new podcast, Into America. In our latest episode, Republican giant and longtime Senator Lindsey Graham is for the first time ever facing a real challenge to his Senate seat. Can a relative newcomer to the scene, a black Democrat in a red state, win this fight? I head to South Carolina to find out. Search for Into America wherever you're listening right now and subscribe.
It's TuneIn Sports on this day. On this day in 1978, Angels pitcher Nolan Ryan strikes out 15 Mariners. The 20th time he struck out 15 batters in a game.
He's one strike away, and these fans now are cheering for Nolan Ryan. 41,411. They'd like to go home saying, I saw my first one.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history.
There it goes, 3-2 pitches, hit in the air and hit well. Center field, Bader back, at the wall, it's gone!
Search classic game replays to relive some of the great contests in America's pastime.
Ground ball out to Jackie Robinson, up with it over to Reese for one, back to Hodges. It gets away from him. Ferris trying to go to second.
It's on demand, it's free, and it's only on TuneIn.
Introducing a new podcast, ESPN Daily, hosted by me, Mina Kimes. When you want to go beyond your feed, when you want to get inside the score, when you want to get behind the highlight, there's ESPN Daily.
Markets in a pretty narrow range today, going between the red and the green ahead of a very busy week for earnings next week with names like 3M, Starbucks, Comcast, Microsoft, Tesla, and more. We're back after a short break.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn.
Get the latest breaking news alerts and listening suggestions for news stations and podcasts. Let TuneIn keep you in the loop with push notifications. Just go to your device's settings and allow push notifications from TuneIn to get live alerts and recommendations on the audio you want to know about.
It's TuneIn Sports on this day. On this day in 1978, Angels pitcher Nolan Ryan strikes out 15 Mariners. The 20th time he struck out 15 batters in a game.
He's one strike away, and these fans now are cheering for Nolan Ryan. 41,411. They'd like to go home saying, I saw my first one.
To listen to conversations breaking down the moments just like this, search sports to be part of the discussion on TuneIn.
Day 2 of the 2020 NFL Draft is on TuneIn.
Jets, that's going to be the hot spot for this draft early on, right? We're going to see if a team's going to try and get up into that spot and see if they want to pick one of these quarterbacks. And I'm watching to see where my guy Dwayne Haskins.
With round 1 in the books, there are still plenty of great players on the board waiting to hear their name called.
We're the only guy in this draft that has Aaron Donald potential. Who's going to get up and take it? And look, I'm looking at Oakland, the Raiders, and John Gruden sat there yelling at me for all the...
To your business, get advice. We're here to help. Go to cnbc.com/smallbusiness.
Welcome back. Real-time voice transcription service Otter AI is adding new features for students and professionals working from home. The company announcing it's integrating with Zoom and other services to provide live video meeting notes. And joining us now to discuss the partnership and how the software works is Otter AI CEO Sam Leung. Sam, good morning.
Good morning.
So I got to say off the top, I am an Otter user, heard about it from producers here at CNBC, really been impressed at how it transcribes interviews, for example, in real time. But tell me, first of all, during this period of lockdown over the last month or so, what sort of usage changes have you seen?
We have seen tremendous growth in the usage. Actually, in the last months, we've seen 5x growth in terms of meetings being transcribed. Many meetings are done over Zoom or other video conferencing systems, but the number of meetings, number of hours people use this service has just grown tremendously.
And why is that, do you think? I mean, on the one hand, it's kind of obvious that this is the way that people meet now, but even with in-person meetings, I don't necessarily get a transcript of the meeting. Is it because people who aren't in the meeting need to understand what happened, or what should we take away? What should we learn from that shift in usage?
Well, there are several reasons. One, when everybody's in the office, you can walk over to their desk and ask questions. It's very simple. But when everybody's working from home, you have to use some technologies to communicate. And Zoom and other video conferencing system, are the best tools you use. When you're having all these meetings, actually, when you're working from home, one reason is that you are often distracted by other things, the kids, the dogs, and other things. So how do you take notes? We have surveyed a bunch of people. They tell us they may have 20, 30, even 40 hours of video conferencing every week.
Yeah.
So they'll back-to-back meetings make it really hard to remember and track the information.
Morgan's going to jump in here, but I just want to note what you're seeing on your screen is a live transcription of this interview right now on Otter, so the viewers can kind of see in real time how it works. Morgan?
Thanks, John. So, Sam, you just mentioned 5x growth. How do you keep all that data safe?
Yeah, all the data is stored in the U.S. on AWS data center. It's encrypted in transit and at rest. The user has a full control. Whenever the user decided to delete anything, we absolutely erase everything. So we have a very strict privacy policy in terms of service to maintain, to ensure the confidentiality and security of the user base.
What do you say to those who, at least when it comes to Zoom, have said we don't trust the technology, whether it's New York City schools or Alphabet or the Taiwanese government? I mean, what is the best sales pitch to say come back?
Well, first of all, I think Zoom, they have been super transparent. I think the CEO, Eric, is doing a great job. They're very open. They invited external security experts to audit their system. They might have made some mistake, but I think they're fully trustworthy. We've seen, large companies like Oracle, Larry Ellison, and fully trusted Zoom, company like Bridgewater Associates. They trusted Zoom, and actually Bridgewater Associates is also a customer for Otter. Ray Dalio, he has this radical transparency principle, and they want to report and transcribe all their meetings, and they're using Otter now.
Now, Sam, your LinkedIn profile says that Otter is hiring currently, and not a lot of companies are. So tell me, what are you hiring for? How much of it has to do with this surge in usage? And what should investors and just people who are concerned about the economy and small business take away from the fact that you're still hiring?
Well, in this period, it's definitely a very terrible time. However, people rely more on collaboration technologies like Zoom and other video conferencing systems. And now Otter comes into play and provide a new way to collaborate and communicate. So our users are growing, our workload has been growing tremendously. So we do need to hire more engineers, more AI experts to further improve the technology, creating new natural language processing technologies to analyze the meeting and help people track and understand and share the information better. We're hiring, across the spectrum, engineering, sales, and marketing to further grow the business.
So, Sam, I realize that Otter Premium is a subscription. There's a subscription fee, but the basic plan comes at no cost. How are you making money on this?
Well, this is a free model, freemium model, similar to other collaboration software, including Zoom, Slack, Dropbox. So we provide some free service to millions of users, and just to give them a chance to experience the service. And when they see the value, many of them decide to upgrade and subscribe to the premium or our enterprise plan. So, our service is based on the monthly subscription or annual subscription.
Well, it is certainly good to see innovation continuing, hiring continuing, even despite the situation that we find ourselves in. Sam Liang, the CEO and founder of Otter AI, thanks for being with us.
Thank you very much.
Getting some new guidelines from the Small Business Administration on PPP loans and how they pertain to hedge funds and private equity. Let's get to our Eamon Javers. Eamon?
Yeah, Carl, that's right. What they're saying over at the SBA is that hedge fund and private equity firms are not now allowed to get PPP loans. This is new guidance coming out from the SBA saying that hedge funds and private equity firms are primarily engaged in investment or speculation, and such businesses are therefore ineligible to receive a PPP loan. They're saying that the administrator of the SBA does not believe that it was Congress's intent for these types of businesses, which are generally ineligible for these types of small business loans, to get PPP financing. So that clears up one element of the mystery around all of this. One of the other elements here is this idea that they're emphasizing here that you have to certify as a borrower that the uncertainty around COVID is impacting your business. And they're warning here that they may go back and check those companies that are now applying for PPP loans, whether or not they really were impacted by COVID or whether they were struggling previous to the virus's impact. So that's one thing for borrowers to watch. Marco Rubio, the senator who was keenly involved in all of this, tweeted earlier today that he believes the PPP program will be back up and running, Carl, full time on Monday, and we'll see how long those new funds last. That first round went awfully quick, and the expectation is this new round will go quick as well, Carl.
Yeah, and Eamon, even earlier this morning, Robert Frank tweeted a figure of the number of public companies who received PPP assistance, and it's just amazing how this one program, which is barely a few weeks old, has had multiple political sand traps.
Yeah, absolutely. And companies really didn't know what they were getting into here. This all happened so quickly. People had to make judgments very, very fast. And maybe a lot of them were thinking primarily in terms of dollars and cents and not in terms of the political impact of that. And you've seen some of the big universities like Harvard reverse course here and back out of some of the funding that they got under the CARES Act, not necessarily PPP. A lot of companies now realizing there's a political element to this as well as a bottom line element.
All right. Eamon, thanks. We'll watch that closely ahead of a very busy week of earnings next week. Everybody have a great weekend. We'll get to the half and the domino.
All right, thanks very much, Carl Quintanilla. Our breaking news coverage on CNBC continues right now. I'm Dominic Chu in for Scott Wapner today. Front and center this hour, markets running out of steam and some reasons to keep marching higher as bad news keeps coming in about the state of the economy. Now, this, as some parts of America begin to reopen, what does it mean for you and your money, and where do we go from here? We are going to debate that with our investment committee today. They are Joe Terranova, Steve Weiss, John Najarian, Kevin O'Leary, chairman of O-Shares ETFs, and Kate Moore, head of thematic strategy for BlackRock's global allocation team. Welcome to the entire committee. Let's check on the markets first this hour because, like we said, we have run out of steam. The Dow Industrials right now marginally to the downside, down about 31 points in the red, down about 0.1%. The S&P 500 just about even right now, flat on the day, the level 2798 there. The Nasdaq Composite up about 0.2%, and the Russell 2000 flat as well. So as you can see, that steam running out as we've rallied so strongly off the lows that we saw just about 1 month ago. Let's go to our investment committee with the traders here, and perhaps we will start with you, Joe Terranova, because you are the one right next to me in this 6 box. What exactly is happening right now? Have we run out of steam for this particular rally?
Well, I don't know necessarily running out of steam is a bad condition. Markets generally, when they rally significantly, need a pause, and that pause is generally a consolidation type of pattern in the markets. I think right now most investors and most speculators are anticipating a rollover. And the concern that I have is that a lot of people are positioning for that rollover and losing money because they're not getting it. I think one of the indicators that you need to watch if there is going to be rollover is the volatility in the Treasury market. The volatility in the Treasury market, specifically the U.S. 10-year Treasury, that telegraphed the precipitous decline that we saw towards the beginning through the middle of March. What happened was we saw a significant contraction in that Treasury market volatility over the last 4 weeks, and it's concurrent with the recovery that you're seeing in the equities market. So for me, if we are going to experience the rollover that everyone expects to occur, you're going to have to see a little bit of elevation in the Treasury market. And just to put actual numbers to that, Dom, 1 month ago when markets were declining, the average weekly range for a U.S. 10-year Treasury was about 75 basis points. This week, we have a 10-year range of only 11 basis points. So we've seen significant compression in that volatility, and that's a good condition. I think it's one of the reasons why we're sitting where we are.
All right, so as we talk about some of the overall themes playing out, there is a close eye being paid right now to what's happening with the Treasury side of things. Is that, Steve Weiss, resonating with what you're seeing? Is this pause, in essence, happening as gold prices maybe stabilize, Treasury yields start to kind of hover around and coalesce around certain levels, the safe havens, so to speak, doing what they're doing right now? Does it all mean that this is now basically putting us in a trading range?
Yeah, my position had been that we are in trading range. We're at the upper end of it, and that now we're not going to test the lows, but but we're going to consolidate with a lower bias. And let me tell you why I feel that way. First of all, the market is trading like one big biotech stock. We saw it with the story that came out on Gilead yesterday. It took down a market that had been very strong during the day. Not sure that strength was warranted. Then today, when we got the news that CNBC broke about the chloroquine trials being stopped because the primary outcome was death, death is a bad outcome in any biotech trial, but don't worry, we can always mainline Lysol, something like that. That's the next recommendation that came out of the White House. But if you take a look at what companies are doing when they report, they're reporting great quarters, some of them. But the market's not willing at this point to look through what their guidance is. A couple of examples. Verizon, let's not take that one because they did lose subscribers, their phone subscribers, wireless, which isn't really supposed to happen. But if you look at some others, you look at Xilinx that reported a great quarter. You look at Teradyne reported a great quarter, and the guidance is kind of squishy. Well, guess what? It's going to be squishy because you don't know when this will end. So when you're taking those stocks down, as well as a number of others, that's got to give you some pause in the market that we've moved a lot. We've given a lot of credit to this coming out of this sooner than perhaps we will, and normalcy returning sooner than what will actually happen. So we're not trading down significantly lower than that, but we are hitting the pause button, saying exactly what am I paying for at this level, and chances are you're paying too much.
All right, so let's talk a little bit about this idea that the pause button is being hit, because if we are, in fact, in a trading range right now and will be for a while, it's something that could really perhaps benefit those people who take an active approach to management. We've been talking so long about the prevailing theme for markets being passive investing, index investing, yet Goldman Sachs and the analysts and strategists team out there out with a note basically saying that there are better opportunities right now for stock pickers, and that the best outcome for stock pickers would be for this market to be stuck in a trading range. If that is in fact the case, if now the alpha, the outperformance is going to be generated because people can tactically position in certain types of stocks or industries, does that then mean that it's a self-fulfilling prophecy? John Najarian, I'll go to you, because I've seen the VIX, the CBOE volatility index that measures stock market volatility in the S&P, collapse from a high of 80 plus during the lows that we saw last month to hovering around 40. Now that's still high, but still it means that volatility is coming down.
Yeah, and it has been coming down in a variety of places. The one you cite, Dom, of course, is the broadest and the one that represents, the trillions of dollars that are in the U.S. market. But also this week alone, we saw crude oil volatility up over 500, Dom. It's back down to 200 now. And I would say that crude is one of the reasons that today, as we saw the rollover in crude, it's still holding on to some gains, but nonetheless, stabilization in that market, stabilization in our markets. I do not disagree with Joe that consolidation isn't a bad thing. When you get consolidation, you get folks a little more comfortable than when the market is making these incredible gyrations up and down. So you're seeing that stabilization. Granted, these are baby steps, Don, but you're seeing baby steps in the crude oil contract as far as stabilization. You've seen more than baby steps because, as you say, it's been a whole month now that we've seen that stabilization coming into the broad market, S&P 500, Dow, even the IWM. So I think there's going to be great opportunities. It's one of the few times I'm agreeing with Goldman Sachs because I think the opportunities right now are absolutely in trading and not in investing at this level.
So let's bring Kate Moore into this discussion right now. One of the other things that stood out to me in this Goldman note, this idea that we believe the main reason why the recent market rally has offered better alpha outperformance opportunities than typical rallies is that, unlike others, the rally has not been associated with clear outperformance of cyclicals or economically sensitive stocks. So there are particular stocks and areas that are not just going all up together or all down together. Is that thematically what you are seeing play out, Kate, as well?
Hey, Dom. Well, first of all, good to talk to you. I would also say that when we think about the dispersion in the market, we think about dispersion in terms of the cyclicals and the defensives within each sector and within each industry. That really is a great environment for active investors and for stock pickers. So I tend to agree with that idea. But I think I'm going to sort of, frame the opportunity set for the broad market in two buckets. The first is there are some tactical opportunities if you want to play the range, if you want to think about increasing your beta at certain points when the market sells off a little bit or reducing at other points. We certainly try and toggle up and down our risk as we look at our indicators around positioning and sentiment and flow. But this is also a great time for active investors because if you step away from your screen for a moment and you start asking questions about what the biggest drivers are going to be of the market, of the economy, where the changes in activity will be over coming years, you might really find yourself in a position to start building interesting positions in your portfolio that you wouldn't have had an opportunity to do, let's say, in January or February. So I would say you can be tactical in the near term. That's one bucket. At the same time, this is also a great opportunity as the market is gyrating in a trading range to step back and do longer term work about what the big, persistent, and discontinuous changes are going to be in the market.
Okay, let me please follow up with that because I want to know then, in your mind, what exactly are those particular themes, those trends, those types of the theses, if you will, that you want to develop given that kind of environment that you've just laid out for us?
Well, we've been really focused on looking at themes in a couple of the major sectors that, frankly, are well-loved sectors, but where we see, a huge amount of growth opportunity going forward. One of them is in healthcare. We've talked a lot about the opportunity for telemedicine and healthcare technology, innovation, and actually perhaps a slightly changed regulatory environment after this cooperation we're seeing between some of the healthcare companies and government as a result of this COVID-19 crisis. So I think there's a number of different industry and specific themes within healthcare. We're also looking a lot across technology, something I've talked about a lot. We're seeing individuals and companies use technology differently. And I'm really encouraged by the number of new companies that are coming out with interesting solutions as we all work from home. BlackRock's been talking about the fact that we have 16,000 employees working in 16,000 locations seamlessly. And a lot of that has to do with the investment we've made in technology. I expect more and more companies to increase their technology spend, even if they reduce their spend in other places. So whether it's around software or hardware, cybersecurity, or anything else to keep the pipes moving in remote locations, I see a huge amount of opportunity there. And then don't also forget that there are other themes in technology around 5G and around the speed of connectivity that I think will be really relevant to the consumer side over the next 2 years. And we're seeing opportunity to build up positions there.
All right, so this is a great time to bring in Mr. Wonderful, Kevin O'Leary, because you've got a great view of what's happening with businesses all over the world, but specifically with regard to companies that you even invest in. You deal with all different types of industries. Give us your take on what exactly is going on with the economy. Let's start first here in the United States and North America. Has there been a fundamental change, a fundamental tilt towards other types of things given the COVID-19 outbreak? And because Kate just mentioned all of these different particular moves she's making with regard to industries and everything else, can you see from your standpoint the economy here in the way that it's played out with this virus changing fundamentally in the coming months and years?
I do see some fundamental changes that are going to permanently impair certain sectors of our economy and boost to the upside some others. And I'll just give you an example. I have a snapshot on 50 plus companies that I'm an investor in, either on the debt or equity side, and we have been going through the whole process of the PPP and everything else. And when we saw that bill, it was clear to us that the government wanted us to sustain the employees' salaries of the snapshot of Feb 15th through June 30. And that is at the expense of the landlord. In every one of my situations, practically 100%, we have asked to push our rent for at least 90 days. But there's another form of impairment occurring, and this one is going to be long-term. What we've noticed in operating remotely in all of these companies now for almost over 2 months is that we can do it very efficiently after having spent on new licenses, on new technologies, and upgrading internet connections and all the rest of it. And so what we're planning to do across the board is cut our use of office space and retail space by around 30% on average hoping to get another 7 to 11% cash flow right across the board, because we've learned that from the employee base, there are many that are taking care of elderly parents, for example, or raising children, or they just want to stay home and they don't want to commute. We don't care. The opportunity to save money on rent that we never needed, although could never test. I mean, nobody would have ever done this to a business, blew it up and moved everybody afar to work remotely unless they were forced to, and they were. And now we figured out we can save a ton of money. There is going to be an amazing new America emerge from this with tremendous productivity gains. Unfortunately, not for real estate. That is going to be permanently impaired. I see the cap rates on even AAA office towers in New York and Boston going up because they're going to have to retrofit with all kinds of hazmat air systems, put cubicles everywhere. Whoever wants to get on an elevator with 100 people again? Everybody's going to turn into Howie Mandel when this is over. And at the end of the day, that's going to impair all kinds of real estate. You want to sell your REITs. That's my opinion. I've already done that. I've almost exited every one of my REITs, and that was a core holding for a long time. And the other thing I'll say about the trading range that I have come to just live with is there's only one index to watch. It's called the New York Como Index. It occurs between 12 noon and 3 o'clock every day. Everybody watches New York. It's a giant cruise ship stuck on a rock, 75 stories high, and the virus is causing havoc. But even the traders and the sovereign funds in the Middle East are watching the Como Index. The entire world's indices trade on the optimism of Como and New York or the pessimism. When you want to see recovery, it was the first green shoots of Como talking about stabilizing in outcomes in New York City. And we got back 21% of a 34% decline. Como's the key to watch. We will learn first in New York when restaurants open. We will learn first in New York when sports arenas open. We will learn everything from the Como Index. Watch that one.
All right, so it's interesting, Kevin, that you bring all these up, and especially because later on the show you want to pay attention because we've got Joey Agri, who's the CEO of Agri Realty. He's coming up later on. His particular real estate investment trust deals in that commercial space with retail, but that stock is actually up about 15% so far this year. We'll ask him why that's happening with real estate, so keep it right here. Let's now bring in Matt Forrester. He's the Chief Investment Officer at BNY Mellon's Lockwood Advisors. Matt, it's great to have you here. Let's talk a little bit about Kevin brought up this idea of maybe even permanence versus temporary. There are some things that may change permanently with regard to behavior and everything else, and some things that may just revert back to the way they were years ago when this is all said and done. Let's talk about your view of this. Is anything temporary or permanent with regard to the investment themes going forward?
Well, I think in addition to all the things that Kevin mentioned, I mean, who's going to want to sit in a middle seat on an airplane ever again? Who's going to want to go to a movie theater? Who's going to sit in another crowded theater for a concert? All those things are things that we'll have to deal with. I think those things are real. But I think we would focus on the kinds of things that we can actually measure as to the difference between temporary and permanent. So in the latest non-farm payrolls number, for example, we had only the first glimpse of the types of labor damage that we're going to see to the economy, which was 700,000 jobs or so lost in the non-farm payroll in the establishment survey. And about 170,000 of those were listed as permanent job losses. I think we're only scratching the surface, but if that gives an idea of the kind of magnitude of temporary versus permanent, it might help us. Also, we have looked with my colleagues at BNY Mellon at dividend futures, which is also very interesting because that market is predicting that it's going to take something like 10 years to get back to the dividend levels that we were at before the crisis. So that is on the order of World War I or the Great Depression or the 1918 Spanish flu epidemic, that it's going to take us quite a bit of time to get back to where we were before. Dividend futures in the Great Recession of the 2008-2009 period took only 3 years to get back. So that gives an idea that some pieces of the market are really predicting a much more long-term recovery. And I think that points to the idea that there is going to be some real permanent dislocation to capital and labor resources in the economy.
All right, so that's an interesting take there. Matt, let's bring it back to our investment committee here. As we talk about some of these bigger moves that are happening with this marketplace, Steve Weiss, you made a number of portfolio changes given what we've seen over the past few days here. Take us through what exactly you did and what the reasoning behind it was.
Well, the reason behind it is what John pointed out, is that you have to take what the market gives you, and there are phenomenal trading opportunities in this market, both on the long side and then taking profits, when the market gives you too much. So, for example, I had sold Target before the quarter, before the comments were made by Cornell, for the very reason I stated. That sure, sales are going higher, but so are costs, and they're going to be selling a lot more lower margin goods. So when the stock got hit yesterday big, it was an opportunity to go and buy it and to trade around it. Others, the positions get too big because the news is good and you want to lower exposure. So I've been in the lowering exposure mode. I'm comfortable where I am, but on the margin trading around it. But I want to address a couple of things that have been said. Kevin said he sold all REITs. Well, all REITs not created equal. If you're on one hand saying that you're going to use less office space, you may need more apartment space, particularly if you want to put an office in your apartment. So you have to look at apartments. Maybe there's an opportunity there. I know when Joey's going to come on and talk about, his REITs aren't going out of style. As a matter of fact, he's been signing up business. Walmart, for example, because it depends where you are. Walmart, Walgreens, Lowe's, etc. They're going to do quite well. In terms of just the theme I'm looking at, I've been very, very consistent on this. 5G. Everything that was spoken about is 5G related. While 5G was on a nice ramp before, and some of the commentary has been skeptical, this will push it back. The facts are that's not true. So that's why 80% of my portfolio is in 5G related stocks, and they've been reporting very good numbers. Inseego, for example, beat on the quarter and guided up. So there are opportunities from a long-term standpoint. In terms of dividends, I don't know. I know Agree Realty's dividend is safe. I know Cisco's dividend is safe. But I've never been a big one to buy stocks because the dividend is high, because that gives you very little protection on the downside. IBM, great example of that.
So Kate, let's get you back in here with this. I mean, given everything that we just heard from Steve, there are places then of relative kind of outperformance. And yes, if something kind of lags behind, it's because somebody else is benefiting. It's not necessarily a zero-sum game, but there are pivots and movements happening. So you mentioned some of those themes before. Let's take us through then. What types of companies are the ones who could benefit given some of those? I'm not going to call them seismic or tectonic right now, but they certainly are changes happening in this particular market.
Yeah, I think one of the biggest debates, and Dom, you know this really well, has been on whether or not value can outperform, whether or not the cyclicals will lead if we get slightly better economic data. And, we've said that there are a couple characteristics around companies that are going to be the most important going forward, even if we start to get better economic data or return to, some level of normal activity. Not 100%. That's a long ways away. I will say, though, once we start to see live concerts again, I'm going to be pretty excited to get out to see some of my favorite bands. Some of the characteristics that we're looking for in companies is earnings stability and visibility. As we've been going through earnings season, companies have been pulling guidance, suspending any types of guidance. That's obviously affecting how analysts are forecasting future quarters. Those companies that do have some level of visibility, even if they can't give hard and fast numbers, I think are going to be rewarded. The second characteristic is balance sheets matter. We know this. Companies that are super highly levered in this environment have disproportionately been punished. And I think the quality of your balance sheet and how you've dealt with debt and how you're managing your cash. I heard Kevin say before some of the moves that they might be able to make, some of his portfolio companies in terms of maintaining and maybe in some cases expanding margins. That stuff is going to be critical. And I think analysts are going to be very, very focused. We certainly are on the quality of management teams. How are management teams communicating? What are the decisions that they're making? And how strategic are they being in what is otherwise a fairly challenging operating environment? So those are the three characteristics that I think are going to differentiate companies.
All right. The balance sheet, the balance sheet theme has portfolio moves that you're making. And if so, what kinds of moves are you making?
Well, that defines quality. It's a company that has a low debt level. It's a company that could withstand the absence of buybacks in a world looking forward that is significantly going to reduce the amount of buybacks that are presented to the market. And it's companies that have a fast visibility to a return of earnings growth. A sector I think that you could find that opportunity is one that Kate mentioned before, and it's one I'm focusing on, and that is healthcare. And healthcare, and my exposure there is via the ETFs, the XBI, the XLV. I also have Abbott Labs, Eli Lilly, Seattle Genetics, and Baxter International. So I've increased significantly the exposure. The political rhetoric is going to change. The consumer spending will be resilient. The balance sheet is strong. And healthcare offers something else as a sector that's critical right now. If you define the 6 sectors within the S&P that are outperforming the actual S&P, except for technology, 5 of those sectors all have a lower beta exposure. If you look at the sectors that are underperforming, they all have that higher beta exposure. So healthcare in its nature and its construct defines all the qualities that I think you're looking for right now. And it's kind of a forgotten sector, and it's becoming important in terms of its relevancy once again, and that's where I'm finding opportunity.
All right, Matt Forrester, one of the things that caught my eye again this morning, reading through all of these strategist notes, the team over at Jefferies talking about the Great Reset. They say the next opportunity for a sharp market re-rating lies in the discovery of a proven cure vaccine, which even under the most optimistic assumptions is months away. The timeline on the reopening of the economy remains highly uncertain, and the market is vulnerable to a pullback. Do you agree with that? And if so, how do you position?
I think generally, yes. So we're worried that this is going to take quite a bit of time for us to actually reset the economy. And so in that context, I think we're going to get more buying opportunities in all kinds of sectors and industries. And what we would say is a lot of the trends that have been intact prior to the crisis are still going on. The outperformance of growth over value, the outperformance of U.S. versus international, the outperformance of size, larger companies over small companies. We've continued to see these trends, and I would question whether or not those are actually going to change. We've even seen that on the macro side. So we've seen an outperformance of the U.S. dollar versus foreign currencies. The dollar has continued to remain strong. We've also seen some element of these factor trends that have continued to stay with us during the pre-crisis period have continued with us afterwards.
All right. Great discussion there. Thanks to Kate Moore over at BlackRock, also at Matt Forrester over at BNY Mellon's group there. Coming up on the show, a ton of earnings out next week. You've got Apple, McDonald's, Starbucks, Microsoft. The list goes on. And Monday on the Halftime Report, don't miss DoubleLine CEO Jeffrey Gundlach. He will join this show 12:40 p.m. Eastern Time, a must-watch interview. We are back in 2 minutes.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
While you wait for baseball season to begin, TuneIn has dug into the archives and blown the dust off some of the classic games in MLB history. Search Classic Game Replays to relive some of the great contests in America's pastime. It's on demand, it's free, and it's only on TuneIn. Want to know a great way to discover the latest and greatest sports audio on TuneIn? It's easy. Just make sure push notifications are enabled on your phone to receive recommendations of sports talk radio and podcasts, along with important breaking news updates.
You love listening to ESPN Radio live on TuneIn, but did you know you can also listen to favorite ESPN shows on demand? Get the latest takes from Stephen A. Smith,
dynamic duos all over the place,
Dan Le Batard, and Garlic and Wingo when it fits your schedule. And listen to episodes of Pardon the Interruption.
Pardon the interruption, I'm Israel Gutierrez, and I love hosting the show with my humble...
Around the Horn and Highly Questionable as podcasts anytime you want. Search ESPN to see all the podcasts on TuneIn.
With so much of our lives spent at home, are you listening to TuneIn all the ways you could be? With compatibility on your phone, tablet, computer, sound system, smart speaker, smartwatch, smart TV, game console, and more, chances are, if there's a time and a place you'd like to hear the TuneIn audio you love, there's a way to hear it on all the devices in your life. Go to TuneIn.com to discover all the ways you can listen.
Hey everyone, it's Tremaine Lee, MSNBC correspondent and host of the new podcast, Into America. In our latest episode, Republican giant and longtime Senator Lindsey Graham is for the first time ever facing a real challenge to his Senate seat. Can a relative newcomer to the scene, a black Democrat in a red state, win this fight? I head to South Carolina to find out. Search for Into America wherever you're listening right now and subscribe.
America, your children have an amazing superpower. That's right. They can help save lives by simply washing their hands. Just 20 seconds of thorough hand washing after they've coughed or sneezed or been outside can help fight against the dastardly TV.
Welcome back to the Halftime Report. Markets are just about flat on the day. Let's get to Sue Herrera with the latest headlines on the coronavirus. Sue.
Dom, thank you very much, and good afternoon, everyone. There are more than 50,000 reported coronavirus deaths in the U.S. now. Some experts say the actual death toll is higher due to undercounting. More than half of the reported fatalities are in New York and New Jersey. Speaking of which, New York's Governor Andrew Cuomo says President Trump's ban on travel from China was a good idea, but it did nothing to stop the infected people coming from Europe.
Philosophical. When they say it's in China, just assume that virus got on a plane that night and flew to New York or flew to Newark Airport, and it's now in New York. That has to be the operating mentality.
The Food and Drug Administration is cautioning against prescribing hydrochloroquine, or chloroquine to coronavirus patients outside of hospitals or clinical trials. We are also learning a study of that drug, and both drugs actually, was stopped early after more than 20 patients died. Cardiologists have been warning about the drug's heart risks as President Trump repeatedly touts the drug for COVID-19. Heavily indebted department store chain Neiman Marcus could file for bankruptcy as soon as Sunday as the pandemic adds to its financial troubles. Sources tell CNBC the retailer is in talks with its current lenders about $600 million in emergency funding. So there's a lot going on the coronavirus front. As always, you can get more by going to CNBC.com. Dom, back to you.
All right, Sue Herrera, thank you very much for those headlines on the COVID-19 virus. We have a big week of earnings coming up. It's the busiest week of earnings season. 140 S&P 500 companies, 12 of them Dow components will report. You've got Microsoft, Apple, Amazon, Facebook, Caterpillar, Starbucks, Boeing. I could go on and on. They are all set to report next week. And again, the busiest week of earnings season so far. John Najarian, let's start with you here. What kinds of things are you seeing out there right now in the market, in the options market, ahead of what will be the busiest week of earnings and for some of the biggest names in the stock market?
Well, several of those, Dom, that you named, and I'll tick them off. Microsoft, big upside call buying in Microsoft, big upside call buying in Facebook. And in Apple, it's not as large, it's at the money. It's more of not so much a leap, Dom, but just a stabilization and a moving higher in smaller spurts over at Apple. But those three, a lot of speculative paper in those, and almost none of that is to the downside. Now, quickly, Dom, yesterday there was big speculation right at the top of our show before that news broke about Gilead. There was a lot of put buying. So whenever that thing leaked, people on FT, that is, the Financial Times for Gilead and the Remdesivir, that was definitely acted on by a whole host of players. But as far as positive, take a look at Zoom, Dom. It literally zoomed to another all-time high. 300 million people a day were on this thing back April 22nd, just 2 days ago. That's up almost 100 million from how many people were using it just weeks before that. So this one, people were jumping all over upside calls in Zoom, ZM, and they were buying the May 170 calls, Dom. They already tripled in value in one day as the stock hit that new record high today.
You know, it's interesting, John, you bring that up because you talk about the Zoom numbers. At this point, they're on pace to become one of the biggest. They're on track to become surpassing, actually, the biggest social media platforms out there in terms of active users and whatnot. But the one thing that has happened because of all of this internet traffic is the focus on cloud computing and the cloud infrastructure that enables all of it. Yep. And you've got Microsoft, you've got Amazon, you've got Alphabet all playing in that space. And maybe I'll tilt towards Steve Weiss for you here. What exactly about some of these bigger cloud-type players in technology has got you excited or maybe not as excited? And what earnings report next week is top on your playlist this coming week?
Well, what's top is Apple and Amazon. Amazon's actually my largest position. Apple's also pretty big, as is Microsoft. Microsoft happens to be one of my favorite stocks. I love subscription models, number one. I love what they're doing in terms of their business, how they roll out more product. We switched over to their OneDrive from another product, and we love it. It's fully integrated. So that's going to be a very interesting one that's, I would say, out of the headlines more so than either Amazon, and the fundamentals there are obvious. But what's driving both Amazon, or what will be a big part of it, because they've made acquisitions there recently, at least Microsoft has, is 5G. So that's going to power the cloud, more data going there. But also looking at some of the smaller companies. I've talked about Akamai quite a bit. Now, I expect the quarter to be a little weak because one of the things they do is they live stream sports, including the Olympics that are coming up next year, but also football, the NCAAs, et cetera. So it'll be a little weak. If that stock gets hit, I'll come in with both hands to buy it. So that's where you get the opportunities. But Microsoft, I understand the call buying, phenomenal story.
All right, so Joe, amidst the busiest week of earnings season, all of those names, they're all headliners. There is no undercard here for many of these stocks. What has you salivating right now, so to speak, about how to play this? What company stands out to you, and which ones would you be the most bullish or bearish on going into earnings?
Well, I'm going to take a 30,000-foot view of it all. First of all, this is the strength of the equity market, whether it's Amazon or Microsoft or even in consumer discretionary, Starbucks or McDonald's. It's the strength, Facebook. So, again, we talk about this predetermined notion that markets should be rolling over. Well, I'm not so sure you want to place that wager ahead of the strength of the market reporting. But more importantly, and I'm an optimistic person by nature, I think you're going to be hearing from businesses that seem to be able to survive in a very difficult and challenging environment. I think there's going to be a lesson there for other corporations. How is it that these companies are thriving? How is it that they're able to navigate their business model looking forward? So I think there's going to be a very positive communication message that's going to be extrapolated from the strength of the equities market presenting their earnings next week.
All right. I mean, those are key points to watch. And we know many investors out there are trying to pay attention to some of the commentary coming out of these earnings reports, especially from these CEOs and chief financial officers. Kevin O'Leary, I turn to you because you do have this portfolio of companies, stocks and debt that you're investing in. What exactly would you be looking for in the coming week to give you an idea of just what the state of the U.S. economy or even global economy writ large is?
Well, if there's ever a quarter or earnings, publishing and printing to tape that's mattered less, it's this one. This is backward-looking in every way, and I don't think the market is trading on these earnings. And there will be some good ones from Microsoft. I don't remember a quarter where my portfolio has bought more Microsoft licenses than this one. Everybody working away from the office is standardized on their tools now, so they're the beneficiary of that all around the world. But these earnings really have no impact, in my view, on what's going to happen. Trying to guess the multiple on the S&P for the rest of this calendar year is pointless. It's like counting fairies on a pin. You have no idea what's going to happen. The underlying bid in the market, in my premise, on why you want to be equities is this. If you're an institution or a sovereign fund, and I talk to these guys every day, your bogey is 5 or 6% a year. And the mother's milk of those portfolios for decades were govies, long-duration govie bonds. The 10-year right now is yielding 60 basis points. There is nothing to do with that piece of paper anymore. So your bias is to go long companies that are paying out 2 to 3% dividends and hope you can get 3% capital appreciation. You just don't know when that's going to happen. And so the bias to stay long equities will remain right through the quarter, regardless of what earnings are. But there's another issue, too, and this goes to going back at Steve on the REITs. When you pour 2.1 trillion, and then another 2 trillion into this market from a helicopter, because it's basically free money. You have to start to worry about something dealt with in decades. It's called inflation. Long duration assets like utilities, like REITs, like long duration government bonds are going to become toxic waste if inflation starts to show up. People forget the bond vigilantes of the 70s and 80s. The destruction of value is insane. So where do you want to hang out? You want to hang out where there's pricing power in corporations that have the ability to price up. And that is not apartment REITs, by the way. When unemployment skyrockets, you can't raise rates on people while your head is being squeezed by the long duration nature of REITs. That's why I say for now, REITs are no net. I don't have any of them. I still have some in some indices, but personally, zero. I want to wait to see over the next 18 months if inflation rears its ugly head with a $4 trillion helicopter.
All right, well, real estate is certainly one of those places where that debate is playing out full force right now. Thank you guys very much. Now, John Najarian's tracking the action in the options market. Don't miss his latest trades in unusual activity. Plus, coming up, the standout stocks in the communication services sector this year. It's all about fun and games. And as we head out to break, take a look at the S&P 500 sectors. As you can see there, fairly evenly split among green and red at this point. You can always watch or listen to us, as a reminder, on the CNBC app, on the go, anywhere. Halftime is back right after this.
How do you keep track of all your favorite stations and podcasts? Easy. You add them to your favorites list. Just find the audio you want to bookmark and tap the heart icon. Then whenever you want to browse your favorites, you'll find everything under the Favorites tab.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
I'm Mel Kiper Jr., and if you can't watch me break down all the NFL draft picks, then listen to me with ESPN Radio on TuneIn. Just search NFL Draft to enjoy listening to comprehensive NFL draft coverage.
With the NHL season temporarily on ice, now is a good time to catch up on past games.
Bergeron, he scores!
With Game Replay on TuneIn, you can listen to every power play, slap shot, and goal of the 2019-2020 season so far.
Suter to Connor to Fiala, he scores!
And for a limited time, it's free for hockey fans everywhere. Search Classic Game Replays to start listening.
A social distancing tip.
Putting distance between yourself and others is critical to slowing the spread of coronavirus. So here are ways to stay in contact without the physical contact part. Call, send a text, set up a video conference, post on social media, dedicate a song on the radio. If you have symptoms of fever, dry cough, and shortness of breath, call your healthcare provider before going to their office. For more info, visit coronavirus.gov.
Let's all do our part, because we're all #AloneTogether. Brought to you by the Ad Council.
Not all heroes wear capes, but most wear tights.
And here we go, now it's underway! Cover on Rowan, wins!
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis of...
Welcome back to the Halftime Report. It's our monthly look at sectornomics, and this particular sector focuses on communication services, a very wide array of industries going into that particular sector. It's been pretty much a market performer, as you can see there, on a year-to-date basis. But would you believe it if I told you that among all of the big names in communication services, the real outperformers have been in video games and video game publishers? Take a look at Activision Blizzard, Electronic Arts, compared to the overall S&P 500 communication services industry. You can see there clear outperformance from the video game makers. it's one of those themes to watch in a sector that's filled with companies like Facebook and Netflix and other big internet names as well. So with that in mind, Jon Najarian, I go to you. Communication services is one of those MAGA type particular industries, sectors that we like to look at. Are the video game makers appealing to you, or are there other places in comm services that get your attention more?
Well, Nintendo certainly is, Dom. But that one has seen an explosion on the internet ever since we've had this lockdown. But so has Sony with PlayStations, and so has Xbox, which is Microsoft. So I think that the play there continues to be that with kids in particular, or let's say younger adults, stuck at home a lot more, there's an awful lot of playing on these platforms, and Nintendo has been the clear winner here, and it's the pure play in that both the platform as well as the games that they have. Xbox and Sony are there, but those are big companies with a lot of different levers that they're pulling. So that's where I'd go, Dom, Nintendo.
All right, so that's the video game side of things. Thank you very much, John. Let me follow up, if I may, for some of the unusual activity that you are seeing right now. What exactly has caught your eye with regard to what's happening in the options market?
All right, two real quick, Dom. First one, TLT. This, of course, a bond ETF. And we're seeing with that ETF trading just under 170. Now I notice it moving through 170. They're buying the 180 calls with a May expiration. Doesn't mean they think it's going to get all the way up to 180, but they're paying just a little over $1 for those. I bought those today, Dom. eBay. This is a downside play. Somebody's buying puts, fairly big amount of puts. The July 38 puts with eBay trading at 39. So they're just under where the market is here now, Dom. They paid about $2.50 for those puts, and they bought about 5,000 of them.
All right, so TLT, a long-term Treasury bond ETF, as well as those shares of eBay. Thank you very much, Jon Najarian, for that unusual activity. Well, coming up on the show, we've got the CEO of Agri Realty. That stock sliding 20% over the past 2 months. How is this real estate investment trust weathering the volatility in the markets? That's straight ahead, coming up on the Halftime Report.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
Get the latest breaking news alerts and listening suggestions for new stations and podcasts. Let TuneIn keep you in the loop with push notifications. Just go to your device's settings and allow push notifications from TuneIn to get live alerts and recommendations on the audio you want to know about. In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
You love listening to ESPN Radio live on TuneIn, but did you know you can also listen to favorite ESPN shows on demand? Get the latest takes from Stephen A. Smith,
dynamic duos all over the place,
Dan Le Batard, and Garlic and Wingo when it fits your schedule, and listen to episodes of Pardon the Interruption.
Pardon the interruption, but I'm Israel Gutierrez, and I love hosting the show. It's my humble...
Around the Horn and Highly Questionable as podcasts anytime you want. Search ESPN to see all the podcasts on TuneIn.
Hey everyone, it's Tremaine Lee, MSNBC correspondent and host of the new podcast, Into America. In our latest episode, Republican giant and longtime Senator Lindsey Graham is for the first time ever facing a real challenge to his Senate seat. Can a relative newcomer to the scene, a black Democrat in a red state, win this fight? I head to South Carolina to find out. Search for Into America wherever you're listening right now and subscribe.
Want to relive the glory of college football?
Pulls over a man into the end zone.
Come explore TuneIn's classic game replay collection to hear ESPN's complete coverage of the 2019 New Year's 6 bowl games. Don't miss your chance to re-experience the Rose Bowl, the 2020 National Championship featuring Clemson and LSU.
There are going to be 2 champions on the field tomorrow night. There's going to be 1 team hold up the trophy.
Search classic game replays to listen for free.
Brian Windhorst and the Hoop Collective podcast.
What about Giannis Antetokounmpo? He is going to be eligible to sign a Supermax extension, which we were
Okay, welcome back. As some parts of the country start to reopen for business, the question now shifts to how quickly consumers will actually come back to the economy. Joey Agree is the president and CEO of Agree Realty, a real estate firm with nearly 900 retail properties in the United States and counts tenants like Walmart, TJX, and Best Buy among their largest customers. He joins us now on the phone right now. Joey, thank you very much for being here. Let's talk first about just how bad it is in the commercial real estate market given COVID-19.
Good afternoon, Don. I would tell you it is obviously this is a pandemic and obviously a crisis for the entire country. I'll tell you, our tenants started the month of April taking a broad approach to opportunistically not paying rent. What we've come to realize is, unlike other landlords, we're the opposite of a shopping center or a mall owner, as you mentioned, Walmart, TJ Maxx, Best Buy. Our tenant's obligation is very clear. It's to pay their rent, and our obligation is to make sure that we don't breach quiet enjoyment and any de minimis property management responsibility. So obviously the consumer, especially discretionary spending, is far off from norms and is in a hole effectively. But we have a very clear obligation with our tenants and those contractual lease agreements.
All right, so let's talk then about, there's a difference, say, like you said, between Walmart, Best Buy, TJX, Tractor Supply, Sherwin-Williams, who are some of your top tenants, versus some of the other perhaps lower-tier operators that still have a business presence but maybe aren't able to pay those leases and that rent like the way Walmart possibly can. What exactly are you doing as a real estate investment trust to either assist them or find ways for them to actually try to stay in business?
So I say at Agree Realty, with that 900 properties you mentioned, we have very few small mom and pop tenants. We have tenants that are weighted toward the national retailers. We've been solely focused on investment grade, long-term retail winners in the e-commerce world, omni-channel world that we live in today. Now, if we have a small mom and pop tenant that doesn't have a private equity sponsor or random one in our portfolio, we're willing to work with them to make sure in a partnership that they can get through this pandemic and this health crisis. But at the same time, our vast majority of our portfolio today, 60% is leased to investment-grade retailers. And like you said, it's the top operators in the business here. So we aren't working with many mom-and-pop tenants in context of our portfolio.
All right, there's been a theme that we've been exploring for the past few weeks now with regard to COVID-19 and the types of temporary or permanent changes that are happening to an industry. What exactly are the temporary and permanent changes happening to real estate given what's happened with this pandemic?
Well, I think the temporary changes are obviously we're seeing is consumer spending obviously dropped significantly. I think what is more important is to see through this pandemic, and by no means do I see a V or a U-shaped recovery, but to see through this pandemic in terms of retail real estate and consumer discretionary spending, and also on necessities, and where those dollars are going to go. And in my mind, given the backdrop of commercial real estate for the last 10 years, with one of the strongest economies we've ever had and a strong consumer, which makes it almost 70% of it, we're basically seeing the exact opposite in this pandemic. And now seeing through this pandemic into what could be a protracted recession, where those dollars go and what retailers, frankly, make it through this pandemic and they live to survive. We're focused on those retailers that not only survive, but they will thrive in a post-pandemic recessionary environment.
All right, Steve, you've brought up real estate prominently earlier on in the show. I mean, how do you feel, and what exactly would you be asking a guy like Joey?
Well, in full disclosure, I'm a shareholder. I bought more when it dipped a little bit, and I've owned it for a while. Joey, you're obviously seeing opportunity. You've raised a lot of capital just over the last few weeks, an incredible amount of capital. Where exactly do you see that in terms of regionally and in terms of the type of retailers that you're going to take on? And is that, as part of that question, is that reverse inquiry from like the Walmarts and the Walgreens and the Lowe's that are saying, hey, we want to put more stores up?
So you're correct. We've had two highly successful equity capital raises totaling nearly $600 million in April, headlined most recently by the Cohen Sears $370 million investment. And we have the ability to execute on well over $1 billion of acquisitions while maintaining a very conservative best-in-class balance sheet. I'll tell you, what we're preparing for is a market dislocation here at AG Realty. And what we think is going to happen is frankly, the lack of liquidity in the debt and equity markets, the impaired cost of capital, is going to provide us additional opportunities with those Walmarts and the TJ Maxx and the Best Buys and the Tractor Supplies, the National Tire and Batteries and O'Reilly and AutoZones of the world, where frankly our cost of capital, our tenant relationships, and our ability to execute with the great team that we have is really going to put us in a very unique position here.
All right, Kevin O'Leary, let's have you weigh in here. What would you would ask Agree Realty about something, given your view on the economy right now? What exactly is your thought, and what would you ask Joey about this?
I do have a question for you, Joey. You know, when we went into this lockdown, we were about 16.5% online sales to consumers, ex-autos. Coming out of this, let's say, you know, we're going to be locked down maybe to who knows when. I can't guess. No one can. I think we're going to be somewhere between 20 and 25%. I'm seeing this happen right now with my little portfolio of 50 companies, of which half their sales were retail. They're moving to an online direct-to-consumer model. We don't think that's going to change much. Speaking to your thesis, if all of a sudden a Walmart says to you, which is a AAA tenant for sure, look, we don't need 1 million square feet of retail space. We need half of it to be turned into a distribution center right on your lot, and you're going to pay the CapEx to convert it. Are you going to do that for them?
So it's a great question. First of all, we wouldn't pay the CapEx if that situation were to occur. Our tenants under effectively long-term duration leases. Our portfolio today is approaching 10 years weighted average lease term. Our pipeline and our focus has been heavily focused on the brand name retailers that frankly were brick and mortar retailers who cannot be disintermediated, by the internet and technological strategies that will complement and enhance their physical store footprint strategy. To your point, the 16% sales that are currently online, it's going to be very interesting to see what that retention rate is and how that impacts different sectors and different tenants. So, for example, this country with a 1.5% e-commerce grocery penetration, Great Britain was at approximately 6% prior to this pandemic. What Amazon and Walmart and all of the grocery delivery services are now seeing is that they've been able to penetrate probably the most difficult demographic segment in the country, and that is my parents, who typically don't want to shop online and want to be into the grocery store and look at the fruit and touch the vegetables and go to the produce and deli counter. And so it's a very different world we're going to emerge from. I think the other piece of that equation, and not to be elongated, is we're going to see significant contraction in GLA in this country. We have 24 square feet per capita of retail space in this country today. Your Canada has 16 square feet per capita. Western Europe's about 4.5. We're going to see a number of retailers file bankruptcy. And so where all of that consumer spend goes is not only online, but it is to the best and the brightest retailers. And that's what we're focused on, and that's what we've been focused on.
All right, big themes to watch for sure. Joey Agree, CEO of Agree Realty, thank you very much for joining us on the Halftime Report today, and good luck with the COVID-19 pandemic as well. Well, we got final trades and thoughts straight ahead coming up on the Halftime Report. Keep it right here after this commercial break.
You love TuneIn for live breaking news from CNN, MSNBC, Fox, CNBC, and more. But when you can't catch your favorite show as it airs, it might just be a click away as a podcast. Search your favorite news station to explore all the on-demand news shows on TuneIn.
With the NHL season temporarily on ice, now is a good time to catch up on past games. With Game Replay on TuneIn, you can hear every matchup of the 2019-2020 season so far. And for a limited time, it's free for hockey fans everywhere. Search classic Game Replays to start listening.
In case you didn't know, TuneIn lets you listen to the same radio stations you pick up on your home or car radio, except you can hear them from anywhere. If you want to find a station from somewhere else in the world, navigate to the By Location section under Browse. Keep exploring with TuneIn.
I'm Mel Kiper Jr., and if you can't watch me break down all the NFL draft picks, then listen to me with ESPN Radio on TuneIn. Just search NFL Draft to enjoy listening to comprehensive NFL draft coverage.
Keep up with everything happening in the wild world of pro wrestling with the TuneIn podcast. For expert analysis straight from the WWE to Steve Austin's no-holds-barred conversations with wrestling's biggest personalities, search sports and scroll down to the world of wrestling to listen.
If you've used TuneIn much, you probably already know how to favorite your top stations and podcasts for quick access. But did you know you can organize your favorites too? Under your favorites page on the TuneIn app, hold and drag the stations to rearrange the order to your liking. It's that easy.
A social distancing tip.
Putting distance between yourself and others is critical to slowing the spread of coronavirus. So here are ways to stay in contact without the physical contact part. Call, send a text, set up a video conference, post on social media, dedicate a song on the radio. If you have symptoms of fever, dry cough, and shortness of breath, call your healthcare provider before going to their office. For more info, visit coronavirus.gov.
Let's all do our part, because we're all #AloneTogether. Brought to you by the Ad Council.
Breaking news coverage continues tonight on CNBC with a special report, Markets in Turmoil. That is tonight, 7 p.m. Eastern Time. And on Monday on the Halftime Report, don't miss DoubleLine CEO Jeffrey Gundlach. He weighs in on the market, the Fed meeting next week. That's Monday, 12:40 p.m. Eastern Time on the Halftime Report. Time for some final trades and thoughts. Joe Terranova, to you first.
Tom, I'm going to go with the biotech ETF XBI.
All right, XBI, there we go for the ETF. Now let's go to John Najarian.
GDX, Dom. Still love gold. I think it goes through 2,000 pretty quick.
All right, and to you, Mr. O'Leary.
DocuSign, huge beneficiary of the lockdown, and they got you by the signature once you've used it once.
All right, and Steve Weiss for your final thought.
I got two. First of all, Joe's had a great call on the XBI, and I've missed it. I'm usually there. Final thought is I'm just going to wait for a little more of a dip here or be opportunistic when stocks get crushed that I love.
All right, waiting for a bit there. Thank you guys very much to the investment committee. We appreciate it. Kelly Evans now picks up all of our breaking news coverage right now.
Thank you, Dom. Hi, everybody, on this Friday, and welcome to The Exchange. The markets are limping to the finish line after another exhausting week, and the biggest week of earnings is on tap for next week. The major averages are now on pace for their first down week out of the last three. The Dow right now is hanging on to about a 30-point gain today. We're up nearly 200 at the highs. The NASDAQ still up 0.2%. And crude is closing out this week as a teenager. It's just under $17 a barrel, but that big winner after going negative during Monday's wild session. Crude today is up nearly 3%. So again, it's better than minus 36, which is where the May contract settled at the start of the week. We'll need to keep a close eye in just a few moments' time when we get the rig count number that's set to cross the tape at any minute. Give us a sense for just how much supply is pulling back and trying to correct these markets. Before we get to all of that, we have some breaking news out of Washington this hour. The president making some headlines. Eamon Javers joins us. Eamon?
Yeah, Kelly, that's right. The president just finished signing that $484 billion economic aid bill in the Oval Office. He had some reporters in the room, and they're telling us that he made some additional comments. One that's interesting is he said that he talked to Tim Cook of Apple, who told him that he expects that the economy is going to have a V-shaped recovery here, bounce back very quickly after this virus problem. So that's maybe some encouraging news from Tim Cook of Apple. The president also suggesting that the U.S. government might step in order to help oil and gas companies and also airlines. Treasury Secretary Steven Mnuchin telling reporters the administration is looking at several options to help the oil and gas industry and saying that it can be assumed that the U.S. government is looking at taking stakes in energy companies as one option here. The president talked, according to reporters, about the idea of the U.S. government buying fuel in advance and also buying airline tickets in advance as a way of helping the airline industry. So that's something to watch for. And then, Kelly, on those comments that the president made yesterday about the use of disinfectants inside the body and UV light inside the body, those have gotten a lot of ridicule online over the past 12 hours or so. The president says he was being sarcastic about that, and that should have been obvious to everyone. Kelly, back over to you.
Okay. Eamon, thanks. We'll continue to monitor the situation. Eamon Javers with the latest in Washington. Stocks are modestly higher right now as investors digest more earnings on the way next week. Let's get to Bob Bassani for more. Robert.
good news that we passed that interim coronavirus relief package overall, but it's not having a big impact on the market. We're a little bit stuck right now. We need to have a little more news to move the market forward. Just let me show you the sectors here for the week. Dow Jones Industrial Average up for the day. S&P 500, we're still down 2.1% for the week. Again, we're just sort of stuck in the middle here over the last couple of weeks here. Outperforming here, semiconductors doing really well, outperforming all week. There's your leadership group for the week. Consumer staples up today, although down for the week. So there's a lot of like bouncing around, not a lot of clear leadership. Healthcare the same way. Energy has been up all week. This is the first day of the week that it's actually been on the downside. Industrials are having a lot of problems for some very obvious reasons. Number one of which is Boeing. Take a look at Boeing, down 15% for the week. Right by the lows for the month. That durable goods number was not particularly good. Boeing was one of the main reasons for that. We also see General Electric to the downside. That's been down for a little while here. That's sitting near 52-week lows. On top of that, that's weighing on the industrials as well. Finally, just want to note Intel on those report there, their earnings report. A beat, but global growth headwinds are outweighing the impact of the stay-at-home trends in the PC sales area. And by the way, while they gave guidance for the current quarter, they declined to give full-year guidance, part of a big trend in companies simply refusing to provide any long-term guidance. Guys, back to you.
Yep, we've talked a lot about that. We'll see what next week brings, Bob. Thank you. Next week is officially the biggest week of earnings season with the big tech names, the oil names, some industrial names, auto names, the list goes on and on. Now, if you're thinking about tuning out, you're like many investors to write off the whole earnings season due to the coronavirus. But Mohamed El-Erian of Allianz said, whoa, wait a minute. He said these earnings are actually really important. Take a listen.
I would resist the inclination of saying that this earnings season doesn't matter. We should just look through it. This earnings season is providing us a ton of information. And that's important in a market that's differentiating more between individual names. So there's a lot of focus on balance sheet strength. There's a lot of focus on cash burn, on access to markets. That's important because it tells you how well companies will navigate this very difficult period.
Joining me now with more, Jim Paulson, the Chief Investment Strategist at Luthold Group, and David Leibowitz is JP Morgan Asset Management Global Market Strategist. David, I'll start with you. And in a way, the whole country is experiencing a stress test right now like the banks are used to going under. Unfortunately, if you don't pass, you might not survive.
No, I think, the first thing that it's important to recognize is that the global economy is in the process of being locked down. And what we're fundamentally dealing with here is a cash flow issue. And, that's why I think focusing on some of the earnings announcements and some of the guidance that we're getting is so important. I mean, cash flow is drying up for both consumers as well as businesses. And so the stimulus packages that we've seen passed up until this point are meant to help these economic agents bridge the gap between where we are today and the economy coming back online. But we really don't have a good sense as to, whether they're going to be able to make that journey. And so I think figuring out the starting point, which is really what the first quarter earnings season reports are providing us, is particularly important because it gives us a sense of how we're oriented as we continue to work through this over the coming quarters.
Yeah, Jim, we're showing some of your thoughts on this market right now about thinking the bottom is near and so forth. But to David's point, Mohamed's point, I just wonder if, it's not so much about timing the rebound and picking the S&P 500 or picking a low-cost sector ETF. Jim, I wonder if the whole point of this exercise is for individual investors even to maybe determine which companies they think are safe for the long run and which might not be.
I sort of subscribe, Kelly, to the other side of the argument here that I think there's not that much information in data that's just free-falling, whether it's economic data or earnings data, free-falling data. We know the reason behind it. If you put the economy in the off position, data is going to free-fall. I think the next important point will be when data starts to bottom, which I think we're getting close to. Economic data in particular. And part of the reason it's getting close to bottom because it fell so much so fast, like everything else in this bear market. I think the data might stay really weak for a while, but it might actually start bouncing around the lows. And when that happens, I think it starts to reconnect investors, companies, and policy officials back to fundamental information that they can start to decipher and delineate. Right. I think it does a lot of good things, including allowing investors to discriminate again between who's doing better than other parts of the economy and what that means. Companies, it might give them a sense of maybe having a sense of that they can make it through this crisis, and policy officials maybe can start adjusting the policies to meet certain areas that aren't recovering as fast as others.
So you would just wait a quarter or two perhaps until that, kind of process of clarifying what's happening in the economy really happens. David, I was just going to say that I think the market's already said, yes, the data is bottoming, and it's already priced that in. And the question now, as we're kind of a little bit more range-bound feeling, is what happens next? And do the slow reopenings turn into fuller reopenings or turn into sclerotic shutdowns again?
Well, and I think that's really the key risk. When we take a step back and think about it, and I would agree with Jim that, you look at the flash PMIs that came out yesterday, to build some expectations around what's happening with the data more broadly. And it does feel like, we are getting close to a bottoming out in economic activity. But, I'm very much of the view that while you can turn an economy off with a light switch, you can't turn it back on in the same way. You need to use a dimmer. And I think that the real challenge here is going to be reopening the economy. Telling people that they can begin to go out again is really only the first step. You need to think about, will people be comfortable going out?
Right.
What capacity utilization will various service businesses have? And more importantly, will they be in a position to rehire the slack that is in the process of being created in the labor market? I mean, the big risk to my view is that as we turn this economy back on, there just isn't sufficient demand to fully reabsorb all the individuals that have lost their jobs over the past couple of weeks.
So before we go, Jim, just want to give you a chance. If there's any companies or investment strategies you think right now you can already bet on.
Well, Kelly, I would take days like today that are up somewhat to lighten up on defensive assets in your portfolio. I think they're extremely overvalued. The price of cash on a PE basis is infinity. The price of the 10-year bond is 200 times earnings. Gold to other commodity prices at a 50-year high. I would do that. And on bad days, which we're still going to have, I would start to add to those areas that have not participated in the previous bull and remain at extraordinarily good values and largely under-owned. That'd be cyclicals, that'd be international, emerging, small caps, high beta type names, and have a portfolio that's positioned for recovery, because I really think that's the next place this crisis is going.
All right. Well put, both of you. Thank you for your time today. Jim Polson and David Leibowitz. Rig counts are out, which we've been keeping an eye on with the massive volatility in oil. U.S. oil drillers, it turns out, cut rigs for a 6th week in a row. No surprise, but they now stand at just 378, and that is the lowest since July of 2016. Remarkably, even with that big contraction, it's not enough to push WTI crude above the $17 mark a barrel in afternoon trading. We still are up about 2%, but kind of gradually hanging on to those gains as we move towards the close next hour. Meantime, a growing number of borrowers are delaying their monthly mortgage payments as the coronavirus slowdown continues to grip the economy. New data from mortgage analytics firm Black Knight finds 3.4